key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
It's not the legislation that we would write if Republicans were in charge of both the House, the Senate, and the White House. This is the best possible product that we can get under these circumstances to take care of these really important obligations.
U.S. House Speaker Johnson has just been talking about votes on foreign aid bills. Bloomberg's Katie Lyons is back in D.C., and I think it is around Speaker Johnson that the latest headlines involve.
Yeah, of course, what we saw happen on the House floor today, Ed, was a procedural vote advancing that will pave the way for funding for U.S. allies to pass the House later Saturday. These are 4 separate bills, one for Ukraine, Israel, the Indo-Pacific, and a so-called sidecar, which is other measures, including the TikTok divestiture bill. All this aimed at getting more than $95 billion in aid to U.S. allies. However, it does seem that the House Speaker could face a threat to his job as a result. This has long been threatened by Congresswoman Marjorie Taylor Greene, who had suggested if Johnson were to put Ukraine aid on the floor for a vote, she would act on her motion to vacate, essentially trying to kick him out of the job. Already one other member, Republican Congressman Tom Massey, had joined her in that effort. And now, according to a statement from Congressman Paul Gosar of Arizona, he too has added his name in support of the motion to vacate. So now that's 3 members of the Republican conference. We're working to identify that Gosar statement or verify it independently, as this has been reported by other outlets. But of course, this suggests, because of the way the math works in the House, Ed, and how tight the margin is, that it will require Democrats to show up and support the Speaker so that he is able to keep hold of the gavel. Whether or not that's just not showing up to a new an ouster vote, whether that is actually outright voting for him, we'll see what form it takes, but it will require help from Democrats to save his job, just as it took massive Democratic support to get this procedural vote over the line today.
There is math on the votes and the bills, and then there's procedure, which you explained really well earlier in the show. We were talking about how Majority Leader Schumer in the Senate had put lawmakers on notice to be working this weekend. Just explain why the pressure to work through the weekend on these bills.
Well, the Senate won't have a chance to act on these bills until the House passes all of them, repackages them together, and sends them to the Senate for a vote. And the way the rules in the House are structured, and what was agreed to when Kevin McCarthy was Speaker all those months ago, was that members had to have 72 hours to read the text of a bill before a vote. And because the text of this bill was released less than 72 hours ago, it cannot be voted on until Saturday. So even though we've seen the rule vote today, which essentially just sets the procedure for how this ultimately will pass when it comes to final package, the House isn't going to be able to clear all of this until Saturday afternoon, perhaps evening, and then the Senate would be able to act after. The Senate Majority Leader Chuck Schumer has said they will do so quickly, which is why they may be staying in town. This may be a Sunday vote or later. And of course, keep in mind, Ed, that in the U.S. Senate, where it is required to do anything quickly is unanimous consent. Any one senator, should they so choose, has the ability to slow down the process. So someone like Senator Rand Paul, for example, if he takes issue with this this bill, could refuse to accelerate the process until he has a vote on an amendment or something like that. So it'll be a matter of how quickly the Senate can get this done after the House completes its work this weekend.
Kayleigh, just very quickly, the situation in the Middle East, is that impacting the passage of any of these bills?
It is, Ed. When you first saw the Iranian attack against Israel, the more than 300 missiles and drones that were sent toward Israel last weekend, you heard an outcry that this underscored the need to get aid for Israel out the door quickly. Of course, that has been attached in large part to aid for other allies, including Ukraine, which has been a much more difficult endeavor. But there also had been growing calls to make sure that the aid for Ukraine comes through quickly, as intelligence was suggesting that it was desperately needed in immediate fashion. So certainly the hot wars we are seeing, not just in the Middle East, but also on the continent of Europe, have really provided a lot of impetus to get this done. The House Speaker himself said the intelligence he had seen recently really underscored to him that this was the right thing to do, that this aid did indeed need to be passed. And of course, it's a decision that Johnson had to make, decide to do the right thing, even if you potentially might lose your job as a result. That, of course, Ed, will remain to be seen.
Bloomberg's Kayleigh Lyons, and tune in to Balance Power later in the day for more updates. Thank you. Okay, now you'll never believe who is going viral. That's right. It's Taylor Swift. Swifties worldwide are gushing about the singer's new album, The Tortured Poets Department. The 16-song record dropped at midnight Eastern Time on Friday. The singer then announced a surprise 2 hours later at 2 a.m. She had actually written a double album titled The Tortured Poets Department, The Anthology, with 15 additional songs. So there I am, in my vehicle, on my way to do Bloomberg Technology, and I got through the first 10. I'm not going to give my favorites just now, but check out social media. There are some interesting titles in there. Let's keep talking about it. That does it for this edition of Bloomberg Technology. A lot of headlines out of Washington, D.C., the Middle East. We are paying attention to the passage of the TikTok divest or ban bill as well. Recap on the pod. Listen to what Kayleigh had to say about the process in the coming 48 hours in Washington, D.C. Check out the pod on Apple, Spotify, iHeart, and of course, we published all the Bloomberg platforms. It's been a week in the world of technology. Thanks for watching. This is Bloomberg Technology.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election?
It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
This is Bloomberg News Now. News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
DOJ or other authorities.
Could face bigger challenges.
Britain's next. Fed was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Shonali Bassick, and Bloomberg Real Yield starts right now. Coming up, Fed officials repeat the mantra that there are no rush to cut rates, and investors send Treasury yields to 2024 highs this week as they reprice the rate path. And geopolitical risk adds tension to the direction of yields. But we begin with the big issue. The message is clear from the Fed.
Rates are going to stay higher for longer.
Higher for longer.
Higher for longer and higher for longer.
Those expectations of rate cuts have been pushed further and further out.
The Fed has made it very plain they want to cut.
The Fed would like to cut.
They're going to remain data dependent.
I think the biggest surprises have been retail sales and payrolls.
The data that we've had from a CPI perspective.
The key question here is around inflation.
They are still seeking that confidence that inflation is coming down.
The Fed doesn't have that good an anchor on inflation yet.
We just don't have the sustained deceleration in inflation for them to even consider going in June.
If you're going to see September, again, you still need to see this softness come through.
If Chair Powell doesn't get a cut in before July, I'm not sure we can get one this year.
The Fed is trying to control the economy.
Yes, if the Fed keeps high for longer, then we will see that slowly wind its way through the economy.
And as markets realize that the Fed is in no rush to cut rates, Vanguard spoke about the 10-year Treasury yield, saying it's in a danger zone and the potential for a 5% yield. Speaking to Bloomberg, the firm's head of international rates said, quote, "We still think that there's a residual long position left over. And if that doesn't manage to be orderly squared away, that disorderly move could be what eventually takes us to 5%. And when you look at that yields move since October, let's take a look, because you did cross that 5% level back then. You've come down meaningfully, but we have been back, obviously, on the rise here, now at 460. Vanguard saying that even a small move higher to 475 could really start to put investors on edge. And when you say higher for longer, here's a chart put out by Torsten Slok of Apollo on Friday, pointing out that normally it takes 8 months from the last Fed hike for the central bank to start cutting rates. And while the length of time has been longer in some periods in the past, we are now at 10 months. And Apollo said the risk here is that the Fed cycle could feel a little different for investors. Now, Fed Chair Powell spoke this week about delaying a rate cut.
Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Joining us now is Katie Kaminsky of Alpha Simplex and John Kirshner of Janus Henderson Investors. When we think about this drive to 5, Katie, how does investor psychology start to change as the 10-year drifts higher, particularly to that 475 mark we're talking about?
Well, if you think about it from the investor perspective, clearly we saw buying pressure start to come in. So we haven't really seen that yet, around 5%. So I think as yields start to tick up, you will start to see people thinking of this as a potential opportunity to get into the rate market and lock in those rates. But in general, the signals have been very strong all year. Short, fixed income, which is which has been saying higher for longer from a technical perspective for quite some time.
How do you think about this dynamic, John? If you think about the direction of travel, what kind of risks are investors pricing in now about getting in at these levels?
Well, it's a very interesting question, Sonali. Basically, never have so many smart people been so wrong for so long as far as what was going to happen with interest rates. And that makes it very difficult, right? Financial markets love certainty. They're getting a lot of uncertainty. I heard the phrase as I was waiting to come on, cocktail of uncertainty. I love that. I may use that myself, so whoever said it, I'd love to give you the credit for it. But look, what we like to look at Janus Henderson is the MOVE index, which is a measure of interest rate volatility. Most people look at the VIX, which is stocks. MOVE is bonds. Normal levels for that is 60 to 80. Got up to 200 a year ago with Silicon Valley Bank. Came all the way down to 86. Now it's back up to 109. That's telling you the markets don't really know how to react to this volatility.
Well, it begs the question whether 5% is even dangerous sometimes. Katie, if you think about the buying pressure that's not coming around this time around, do you think that there's a risk here of a further sell-off, especially when you think about the longer ends of the curve?
Oh, definitely. And I think from a non-equity investor perspective, more of a cross-asset perspective, we've really seen the theme of sticky inflation and potential for higher for longer for quite some time. And this makes sense. I mean, going back to what John just said, we have seen continued high volatility in fixed income. We've also seen continued persistent positive correlation between stocks and bonds. That's very consistent with other periods of history where we saw inflation as a dominant theme. In an inflationary environment, it's very uncertain at which point yields are going to move, and it also puts a lot of pressure on fixed income. So I think that we're going to see potential for that being higher, and that's going to be more of a new normal for at least some time.
What's the read-through for risk assets? When you talk to clients, John, how is this changing the way that they're putting money to work even outside of safer treasuries?
Right. Clients want solutions, right? That's what we're in the business to do. A lot of people know me as one of the portfolio managers on our AAA CLO ETF, JAAA or JAAA. We just crossed the $8 billion mark for that ETF, almost $3 billion inflows so far year to date. What we're telling people is what you want is high quality, floating rate. Don't worry about interest rate volatility. You're getting close to a 6.5% yield. This is the ideal solution for many investors that are worried about interest rate volatility. It comes in an ETF wrapper, so the investors get the liquidity, transparency, and tax advantage, and low fees, probably most important, that most investors want.
Katie, you think about the geopolitical tensions that have been brewing in the Middle East, and you look at the bid that has been in the bond market. It has waned, that bid, even in the shorter end of the yield curve today. But what kind of role do treasuries play in an era of elevated geopolitical uncertainty?
This is a very important question because we have seen persistent positive correlation between stocks and bonds, meaning that bonds and stocks have been very focused on inflation and the role of inflation in that relationship. But what's interesting now, you are starting to see, especially with geopolitical tensions, a little bit of risk-off type behavior today and maybe yesterday, but that has been absent from most of the moves this year. And I think this is very important for investors because we have lived in an era where stocks and bonds have that risk-off property. So if we should have a more challenging environment, we're hoping that they would help us on the long side, but they haven't really demonstrated that most of this year so far.
It's an awkward dynamic because even when you see that kind of flock to safety, do you consider, John, treasuries safe anymore given the volatility we've seen in them?
Well, they're obviously safe from a credit perspective. What we would tell investors, if you want a little more interest rate duration or sensitivity in your portfolio, you should actually look at agency mortgages, also basically government guarantee, and you're getting about 100 to 150 basis points more yield. But if you're really concerned about this interest rate volatility, which doesn't seem to be going away, again, we would go back to high quality floating rate fixed income like AAA CLOs and our JAAA ETF.
You know, we're talking so much over the weekend here about the House advancing an aid bill here. But Katie, as the Treasury looks to refinance, what kind of new pressures does that put on the Treasury market?
Well, I think the challenge is that we definitely still have a very large deficit, and that hasn't come down since COVID. So that is even further pressure on the issue that we don't probably want to start cutting soon, because we could end up with more inflation. And I think that's what's really holding the Fed to some degree, is that the challenge is if you could actually unleash more inflation, that would be a very, very disruptive environment. Let's also add to the fact that we've seen commodities start to tick up, and the disinflationary trend there starting to kind of create worry. So I think we really have to think that this could be a scenario that we have to avoid.
Well, there are the things the Fed can control, and there are the things that they can't control. UBS warning that Fed hiking rates to 6.5% is even a risk. Do you believe that, Katie?
I think all things are possible, particularly for those of us that watch the commodity markets. And what we've seen geopolitically recently is definitely adding to that particular concern. If you look at oil prices, you look at copper prices, gold prices, all of these particular industrial-based metals as well have really ticked up. And that tells us that, we're not really to this 2% anytime soon, which means that we do really need to think about higher for longer. So,
John, what is the trade at this point? You saw investors really recalibrate their expectations for rate cuts. Even some start to think about what a hike would look like. Where do you position from here?
Yeah, I like how you phrase that trade. We tell investors, don't think about trades, think long term, right? A lot of uncertainty in the market. Don't try to time the market. A lot of people thought, I'll just stay in cash, I'll be good. And then we saw at the end of last year, rates rallied, they missed that. A lot of people thought equities were going to be great this year. They have been good, but if rates keep going up, equities are in trouble. Stick with your asset allocation. Trust what your advisors are telling you. Don't think about the day-to-day volatility. Think about right now, yields are high. Real yields are very attractive. Take advantage of that in your portfolio, because this is, some of the best return opportunities we've seen in 15 years in fixed income.
Katie Kaminsky and John Kirshner, we thank you so very much in a very complicated market. Now we're going to bring you some news, because the House earlier today announcing that they have enough procedural votes to advance an aid package for Ukraine, including a provision to force TikTok's parent company to divest. Bloomberg's Kaylee Line joins us now. How do you think through the events of the weekend upcoming?
Well, Shonali, it certainly is going to be a working weekend for Congress. What the House did today was pass a procedural vote that will allow final passage for this $95 billion foreign aid package throughout the day tomorrow, Saturday. It's 4 separate pieces of legislation. One bill with more than $60 billion in military aid to Ukraine, another with billions of dollars for aid for Israel, another for the Indo-Pacific, and then the so-called sidecar package, which includes repo, the taking of frozen Russian assets that could be used to advance Ukraine's war effort, as well as that TikTok bill, which is slightly amended to what had initially passed the House, now allowing ByteDance up to a year to divest it or be banned in the United States. Now, this was passed with a massive bipartisan majority, more than 300 votes, 316 for, only 94 against, more Democrats voting for this measure than Republicans. So once again, we see the House Speaker Mike Johnson relying on Democratic votes to get things over the finish line. Now, because of that, Mike Johnson does face a threat to his speakership. Congresswoman Marjorie Taylor Greene has long said that if Ukraine aid goes to the floor of the House, she would act on her motion to vacate the speaker. She already had another Republican, Congressman Tom Massey, sign on to that effort. And now just today, in the aftermath of this rule passage, a third Republican Congressman Paul Gosar of Arizona has also signed on to support the motion. So the way that this math would work, if indeed they do act to bring this to a privileged vote on the floor that would require action within 2 legislative days, it will take Democrats to help save the speaker's gavel. So that is going to be some drama to potentially watch unfold over the weekend. And then, of course, Shonali, assuming that indeed this package ultimately does pass the House, it will then be put together to send over to the Senate. Then the Senate Majority Leader Chuck Schumer has suggested they will take this up quickly, and members should be prepared to work this weekend to get that done.
Bloomberg's Kaylee Lyons, we thank you for working around the clock to keep us updated. And up next, we're going to talk about the auction block, because the high-grade market sees its slowest week of the year. But the big U.S. banks make up the difference with billions of dollars in volume. Details up next on Real Yield on Bloomberg.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm Shalini Bassick, and this is Bloomberg Real Yield. It's time now for the auction block as investors take higher U.S. yields into account. We'll start with the $23 billion U.S. TIPS auction. It had the second highest yield since 2008, and the primary dealer award was among the lowest on record. Bloomberg Markets team says the results signal a desire for inflation protection in the market. And moving to IG, the U.S. banks shined this week. JP Morgan, Morgan Stanley, Goldman Sachs, Wells Fargo, and Citizens Financial, all with sales pushing weekly volume to more than $31 billion. And over in high yield, theme park operator Six Flags helped to drive sales this week with a $850 million deal. Issuers steadily priced new debt despite those volatile Treasury yields. Sector issuance now tops $105 billion for the year. And sticking with credit, Pearlstone's Evelina Green has a warning for investors.
I wouldn't be surprised to actually see the market come down here, especially again as it pertains to credit. What we have seen at the beginning of this year is yields stay pretty flat, even though rates have continued to come up, and as a function of that, spreads have been compressed. Yeah. I do think that we are going to see a little bit of a catch-up, and I think that that will lead to a correction in terms of credit markets, and not only, again, the more leveraged structures, but also, again, investment-grade companies, which is, again, what everybody chased when rates started coming down from a spread point of view.
Ty Wallach of Atlas Merchant Capital joins us now. You saw almost an insatiable demand by many metrics to start off the year, from spreads to issuance, and you saw that floating into riskier parts of the market. How do you feel about that now, given that rates are seemingly staying higher for longer?
Yeah, first of all, thank you for having me, Shalini. It's great to be here. I completely agree with Evelina. In our Atlas Merchant Capital credit strategy, we focus on below investment grade credit and distressed credit, and we think there are a lot of opportunities now, and there's going to be a growing number, precisely because what she's talked about. Yields are higher for longer and look pretty attractive, but spreads remain pretty tight. If you look historically, spreads are near the 10-year tight levels in the high yield market. And 8% looks great for high yield, but when you can get a Treasury at 5, it's a little tight. So we think there's room for that to correct, and we generally like floating rate assets better today.
I'm really curious about the riskiest parts of the market, because a lot of folks in your market say the distressed opportunity hasn't been there in a long time. How much is that opportunity growing? Yeah, it's growing a lot. I mean, if you look after COVID, there were very few defaults in 2021, and that they grew in 2022. They grew in 2023 up to about 3%, which is kind of average for where the market has been historically. This year, all the rating agencies are projecting that default rates get up closer to 5%. And that's really a reflection of where rates are. A lot of that stress that will become distress is rate driven, because when you have companies that borrowed a lot of money over the last 10 years when capital was really cheap,
They set up over-leveraged capital structures that are all of a sudden, when rates are up several hundred basis points, if they have floating rate leverage or they have fixed rate leverage that needs to be refinanced, they're going to feel a cash flow squeeze.
There are a lot of investors that are sitting around here saying the economy is so strong that they're willing to get into these riskier parts of the market. Do you think they're missing something?
Well, I think there is going to be a great opportunity in distressed credit. I think active management is really important because you're going to have to pick your spots. We're seeing more and more opportunities, but with default rates still rising, if you pick the wrong one, you could lose a lot in a hurry.
So where do you avoid at this point? Of the firms that are looking a little bit more stressed than others, where do you start to pick your bets, and where do you say it's not worth it, they're not going to make it through the cycle?
We spend a lot of time on stressed and distressed companies trying to figure out who's going to be able to refinance and who's not. And it's not just about whether their
at the bottom of the hour.
operating performance and their
Comments
cash
from
flows
Bank
are
of
there.
England's man.
There's a lot more analysis that has to go into it. It's looking at their existing debt, looking at what their covenants allow, looking to see if they have any unpledged assets. Their ability to refinance, looking at who are the existing holders and what are their motivations. There's a lot that goes into looking at distressed assets besides just
The Bank of England's man speaks as a panelist at a flagship seminar on the capital flows during the IMF spring meetings. This is in Washington. There is a live video available on Bank of England's man's entry in the calendar for anybody interested.
Yeah, there's, you could call it creditor and creditor violence. You could call it liability management, however you describe it. There is a growing trend of people trying to take a bigger piece of the pie instead of trying to expand the pie. That's probably the biggest difference in the business since I got into it 25, 30 years ago. But it is what it is. It just means you have to know what you're doing. You have to be able to read the documents. You have to understand what existing creditors are allowed to do, what the issuers are allowed to do in terms of peeling off assets, in terms of layering on debt that's senior secured to you, et cetera.
What keeps you up at night at this point, given that the economy has still been holding up? What turns some of these situations from a 5% default rate across the cycle to something much worse?
It's an interesting question. I don't know that it gets that much worse because the economy is actually still pretty good. In this environment, there seems to be a reversal of good news and bad news. Every time there's a little soft news from the economy, the market goes up because they think the Fed is going to cut rates sooner. By the way, our house view at Atlas Merchant Capital has been for a while that we're going to be higher for longer. I think the market is starting to come around. The Fed has been very data-driven, I'd say, and the data indicates that the economy is still robust. So I'm not as worried about that. I am worried about spreads in the high yield market. And I think that, at tight spreads, that could really correct. And what I think people fail to realize is that when the economy does slow, rates will come down and people get excited about fixed income. But high yield, spreads tend to widen when the economy softens. And historically, that's the case, and that more than offsets the decline in Treasury.
If you think you might see some of that widening and some of the stress start to hit the system here, how much money are you really willing to put to work today thinking it could get worse tomorrow?
So it's a good question. There are spots you can pick, and we're really excited about floating rate debt today. I heard your last guest talk about floating rate opportunities in the CLO market. We're buying a lot of leverage loans, below investment grade loans, but they're secured. They're generally 50% loan to value, and you can earn yields of 10% plus versus the high yield market, which are unsecured bonds, on average are yielding 8% plus. So we actually have a number of situations where we have long short positions on where we're long the secured term loan and short the unsecured bond of the same company and actually making more money on the long than the short. It's not supposed to work that way, right? You're supposed to get paid more when you take more risk.
That is how you make a market. Ty Wallach of Atlas Merchant Capital, we thank you for keeping an eye on everything that's a little bit riskier. Now, still ahead, the final spread, the week ahead, key U.S. data points, including GDP and PCE. This is Real Yield on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time
So in 5 minutes time now, at the bottom of the hour, Bank of England's man speaks as a panelist at a flagship seminar on the capital flows during the IMF spring meetings in Washington. So the live video is pinned to Bank of England's man's entry on the calendar if anyone's interested.
I'm Shonali Bassick, and this is Bloomberg Real Yield. It's time now for the final spread. Coming up the week ahead, Tuesday, Tesla reports earnings, the start of a very busy earnings cycle that includes Boeing, Meta, Ford, Microsoft, Alphabet, and Barclays. And of course, a lot of economic data, PMI data, and then Wednesday, durable goods. You have Thursday, GDP data, and more tech earnings, as we've been talking about. And Friday, we'll round out the week with the PCE deflator. Let's talk about that, because for my final thought, let's think through what it really means, this number ahead. That for Fed's preferred gauge of inflation, Bloomberg Intelligence says that when it comes to PCE, it would look less alarming than that hot CPI print posted recently. But there are still hints of persistent inflation outside of the Fed's preferred gauge. And that's creating complication around the idea of rate cuts coming all before the big Fed meeting for the first week of May. Now from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think
shortly expecting comments from Bank of England's man.
Financial crisis is a very low probability. When someone says their biggest worry, it doesn't mean they think it's likely. It means they think it's possible and would be terrible.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that.
Don't miss Bloomberg's interview with the
Welcome to Bloomberg Markets. I'm Shonali Basak. We're looking at the S&P 500 falling below 5,000 as the Fed resets the clock on its first interest rate cut. Now let's get a check on those markets here because you have the S&P 500 hanging out, as we've been saying, below 5,000, and also some pressure on the NASDAQ 100, down now more than 1.8, almost 1.9%. The two-year yield, you were seeing a little bit of a bid earlier in the day, but now we're back up to 497 on the day. The yield's moving just a bit higher. Same goes for the 10-year yield, up about 462 on that day. Now we're going to look across asset really quickly here because you have seen oil on the rise in the middle of tensions brewing in the Middle East. You have New York crude well below the highs of the week, over at about $83 nearly on the day, up about 0.25%. You have the dollar spot index on the rise once again. Gold spot below the highs that we saw of 2,400 an ounce last week, but still on the rise for multiple days. Bitcoin also on the rise as we await to see how the halvening goes for that cryptocurrency. Now, some movers on the equity side here. Paramount shares are making big moves as Apollo and Sony are said to be considering a joint offer for the media company. Bloomberg Intelligence says this move to submit a new all-cash offer would likely assuage financing concerns. And Procter & Gamble reportedly quarterly sales that fell short of analyst estimates, overshadowing an improved profit outlook. The company is also on track to boost its prices for a sixth consecutive year. More on the state of the consumer in a moment. P&G now down about 0.5%. And Netflix, blockbuster earnings report with subscriber growth doubling Wall Street expectations, but shares are under pressure after the company announced it would stop reporting subscriber data and offering weak second quarter guidance. You have Netflix down now nearly 9%. And let's talk about what's happening in Congress now, because while the House advanced a long-stalled $95 billion aid package for Ukraine, Israel, and Taiwan, it also includes a provision to ban or divest TikTok within 9 months. Bloomberg's Tyler Kendall joins us now with the details. Of course, this is a procedural vote. This will go through the weekend. What can we expect, Tyler?
Hey, Shonali, that's right. So this was a procedural vote, but it's important because it essentially sets up Congress to pave the way for a finalized vote over the weekend on this critical security assistance that they've been trying to pass for months. This is a $95 billion package that would include aid for Ukraine, Israel, and also Taiwan. And as you mentioned, as we've been following closely here at Bloomberg, it includes a provision in there that would essentially force TikTok to divest from its Chinese-based parent company or face a potential ban. Now, we are expecting lawmakers to work over the weekend on this. And importantly, if we learned anything from this vote today, it's that we're expecting this to pass overwhelmingly and on a bipartisan basis. More Democrats and Republicans actually voted for this bill today. And as you know, the House has razor-thin margins of this Republican majority. So House Speaker Mike Johnson really needed Democrats to not only get on board with this aid plan and to support it, but also to come to his defense if he potentially faces an ouster. He's getting some really strong pushback from some conservative members in the party, notably Congresswoman Marjorie Taylor Greene, who's essentially threatening to put forward what's known as a motion to vacate and oust Speaker Johnson. So this week, we've really seen Democrats come to his defense, saying that he put forward this aid. They would actually support him if it comes to that. Next up, we're expecting this finalized vote likely tomorrow, and then the Senate will have to repackage this. I actually spent a long time on the Hill this week talking to senators about this moment, what would happen. I caught up with Senator Tom Tillis. He's a Republican from North Carolina. Shonali, you know him from the Banking Committee. He told me that the Senate will be ready when they get this. They don't care how the House passes it, as long as they pass it so they can get it to President Biden's desk.
Certainly a lot happening over the weekend. Bloomberg's Tyler Kendall, we thank you for your time, for your very deep reporting. She always knows what's going on the ground. We're now going to bring in also Ann Berry, Threadneedle partner and founder, who has been watching the TikTok saga, let's call it. How do you think of the future of TikTok does play out? Of course, we know the company themselves has been lobbying against this move.
There's a very long way to go, Shonali, before TikTok disappears from the devices of US consumers. But look, the fact that this is being fast-tracked shows clearly, I think, that something is going to happen. The lobbying against will continue. The counter-suing, I'm sure, will come up. We saw that the pressure is being applied by China overnight, Shonali, with moves to try and push Apple to withdraw, for example, WhatsApp as an offering on iPhones. So look, I think this is going to take a long time to play out. I do ultimately think perhaps TikTok gets sold, minus the algorithm that has our, security minds very concerned about TikTok. Something will happen, but it's just not going to happen overnight. It's going to be a long way to go.
You and I have talked a little bit about the impact ultimately for the other social media media giants based in the United States, particularly Meta. Of course, we see a flurry of earnings next week alone. How do you think over time that executives will address the opportunity here to step in with the uncertainty around their other large rival here?
Well, Instagram Reels, owned by Meta, Shonali, really is the play, I think, that stands to gain the most from TikTok either being banned or being sold in a weakened form. And if you look at the outlook for Meta's earnings, Reels are becoming an increasingly large part of that firm's advertising revenue stream. Morgan Stanley anticipating $28 billion, up 120% for Reels' contribution to Meta's revenue stream. And, you know, if TikTok goes away as the leading and the fastest growing short-form video platform, Reels really stands to gain. And advertisers are going to have to think very carefully about reallocating their budgets towards other platforms that have really been impeded by TikTok's growth in recent years.
Hey, Ann, what is your favorite pick going into this earnings cycle, given that we have so many of those tech giants starting out next week?
You know, Shonali, I take a look at what's happened to Netflix in the last 24 hours and say, okay, what does that tell us about the appetite of the market for messages they're looking for in earnings right now? Netflix had unbelievable outperformance versus some of its core metrics, and yet the share price is being punished because the outlook for the rest of the year implies a slowdown in growth, and there's going to be opacity around its key metric. So I think as I look ahead to next week, what's going to be really important, market is going to get confidence from clarity, transparency, really continuing to see reinforcement of back end of the year growth guidance, something Netflix was weaker on. And as I look at that, I think Amazon's really well positioned. It's been a favorite of mine for a long time. So many levers to pull, from continued growth in the cloud, everyday essentials doing pretty well for a pressured consumer, continued move on the video side into sports. And I think Andrew Jassy's got the company all guns blazing with many, many different ways to grow.
When you look at some of these tech giants, is the risk more to the downside at this point, given the valuations that we have seen in the last 6 months?
Yes, I think the risk to the downside, Shonali, sits in the latter part of your question. I don't think the risk to the downside is around the actual absolute earnings performance. And for big tech, it's actually been pretty strong if you look at the last couple of quarters, especially on the cost-cutting side. What I fear is that priced into the valuations we see in big tech at the moment are expectations around, for example, generative AI delivering measurable, monetized contribution to the bottom line. And I just don't think that a lot of the big tech companies can point to hard numbers justifying the AI euphoria that we've seen over the last 4 to 5 months. So that's my concern, not the earnings dollars or the earnings trajectory, but the expectations being set far too high relative to where trading and those deliverables could be right now.
And because you do like the AI sector here, and you have said so much about Amazon already, outside of Amazon, is there anything you like, especially where valuations have run?
Well, I think Alphabet's got its work cut out for it. It really needs to show some progress on generative AI, really sort of pushing in and delivering both efficiencies, seeing that come through on the margin side, and understanding how they can follow in the footsteps of Microsoft, that's been pretty savvy and pretty explicit about how they're going to price their AI offering to their consumers. I think another piece that's sort of buried in this a little bit, Shonali, and where I'd be looking out for this on the earnings calls, if it's not necessarily in the headlines, is a lot of these players have been trying to move and partner with the likes of Disney, the likes of others, to try and figure out a way to move more aggressively into using AI for ad tech, for advertising technology. Again, something touched on by Netflix. That's a theme I think we're going to hear get louder and louder and louder with the likes of Amazon to go back to as it talks about the ad platform that's sitting inside its content business.
And as we're speaking, we're looking at the lowest levels for the NASDAQ 100 since January, actually hitting session lows as we speak. And Barry, we thank you so very much for your time. That is Threadneedle partner and founder from Washington to Seattle. Now, coming up next, we're going to talk about American Express because revenue jumped as U.S. consumer spending stays strong, but the company still sees cracks in small businesses. It's our stock of the hour. Up next, this is Bloomberg.
Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's time now for the stock of the hour. American Express reported revenue that topped estimates in the first quarter as consumers flocked to premium credit cards. Revenue jumped 11% in the quarter and expects full-year revenue to climb 11% as well compared to 2023. And CEO Stephen Squeri told Bloomberg, quote, that the softness in the business is small businesses due to the organic decline, but otherwise they had tremendous growth and it is just tapering off a little bit. And we're going to discuss what's going on with Amex with Bloomberg's Catherine Doherty. You know, it's interesting because one thing that the market is really shrugging off is this idea of provisioning for bad loans, this idea that $1.3 billion to cover loans that go bad was higher than last year. Last year, the market kind of freaked out when they put those provisions up. Why does it not matter now?
It does seem like the market is digesting this in a different way. Analysts were expecting 1.1, so the 1.3 is only slightly higher. But if you just look at the numbers of what this company is actually making, what they're generating, and comments like the softness, they're not seeing that as it relates to the demand for premium cards. I think all of that is seen as a bright, forward-looking commentary that is really helping the market digest this in a positive way.
Well, it begs the question if we are seeing really a lot of the card growth come from the wealthier consumer. Where exactly are they seeing the biggest areas of growth?
So today they talked a lot about spending on airline travel being up. What was really interesting is that was boosted from bookings in the front end of the plane. So this is first class tickets, business class. So you're really seeing that the demand is coming from the higher end, the significant spenders that are looking for perks, they're looking for travel and other luxury items that they can spend on. And it seems as if the strength is still there and will continue. And so when you think about the weaknesses, as you had alluded to in the beginning, the CEO is saying that the the weaknesses are at the lower end spenders. But again, it seems as if these premium products are catering to the higher end spenders.
Leverage is alive and well so long as you are flying first class. Bloomberg's Catherine Doherty. Earlier this week, we also learned that U.S. retail sales remain strong. We're going to discuss the state of the consumer with Rodney Williams, the co-founder of Solo Funds, a financial services company focused on community banking and lending solutions. And he says, quote, "The fact is more Americans than ever before are living paycheck to paycheck with limited savings." Rodney Williams joins us now. Rod, what do you think is exactly happening here in the economy? If the data shows so much strength, but we know anecdotally that so many people feel stretched, how do you explain what's going on?
Well, I think the strength is related to the employment rate, and that's great, or it's in a good place, but you have to also talk about surging gas prices, sky-high mortgages. I mean, rent is at an all-time high. I mean, if I'm correct or not, rent rose 6.5% in the last 12 months when you look at the previous December. Inflation is real. You almost can kiss this notion that it's even under control or slowing down. To this average American, things like food, fast food, is significantly more expensive than it has been in the past. And this is causing constraints that you wouldn't imagine, where people are living really, really slim despite having solid employment.
One dynamic that I've been wondering a lot about is if you look at the data coming out of the largest banks, you see a drift higher in FICO scores. This idea that they are catering to the consumers with fortress balance sheet. If you look outside of those with a credit score outside of 750, let's call it, and that's even lower than Bank of America's average on a lot of business lines, how much do you see them having to put ordinary goods, groceries, gas on their credit card bills at a time where also APRs are sky high?
Well, I think not only are APRs at a sky high, balances on credit cards are at an all-time high. So you're absolutely right. The average consumer is putting more everyday expenses on their credit. That includes planned expenses and unplanned expenses. Those things still happen when you live every day. And that means a medical emergency, that means the flat tire. So, what we see is that, number one, there's more consumers today that are over leveraged than ever before. When you think about a product like what we offer, which is a community-based loan for a few $100s, we see more users that make over $100,000 a year and have a healthy FICO than we've ever before seen in our history. It's talking about a couple of different challenges. I think the number one challenge is expenses are higher. I think the number two challenge is that getting a flexible loan to manage the rising costs is actually also extremely difficult.
How do you think about the crunch consumers are being put under as they take on more debt? Do you think it's going to create a vicious cycle of sorts?
Yeah, I have a big problem with the concept, right? When you think about the FICO and you think about credit, paying a credit card over time is what it's taught. Installment loans are what we have communicated as a benefit. It actually creates the current problem, which what you see is stable or increasing FICO scores, but consumers being over leveraged, meaning they have too much credit, meaning their balances are too high. This creates a scenario that they're living in a really sensitive place. In 2023, we ran the cash poor report. And this is what we were talking about, where consumers are cash poor but credit rich. And that is the same problem. It's almost an evolved problem that we're seeing today, where more expenses than ever before are being managed by credit facilities and credit products that are paying over time and incurring a ton of fees, which continue to kind of create this cycle. We think it's a big problem.
What's not being reflected in the data that you see from the Federal Reserve or a lot of these banks? The reality of the buy now, pay later revolution, let's call it, is not reflected in FICO scores and is not reflected in credit card balances. Are perhaps consumers more levered than meets the eye?
They're definitely more levered. But these products only exist because consumers need them. They're demanding them. And it's not like the traditional players were trying to introduce these products. It's not like our traditional banks were trying to think of innovative solutions that we're meeting the needs of these consumers. These fintechs have been doing this. My company has. So for me, I think what's the problem in the message is that I truly believe regulators and politicians need to figure out how to work alongside technology and innovation to start to bring better products or support the products. I think there actually needs more support for the buy now, pay later, the earned wage access, and the community-based finance solutions of today. Because when you think about their penetration
In 10 minutes time now at the top of the hour, see the release of the weekly Baker Hughes numbers. Oil rig count, prior was 506. Total rigs, the prior was 617.
Or some credit card facility. Traditional players are still by far the number one players to everyday Americans.
Rodney Williams, co-founder of Solo Funds, we thank you for shining a light on the bigger picture here. Now let's check markets before we go to break, because we are watching markets really on the decline here. The S&P 500, the 6 days of losses that we're seeing is actually the longest losing streak since October of 2022. Today's losses alone don't tell you the whole picture. The NASDAQ 100 now down more than 1.6%, a little bit off the session lows, but still down on the day nonetheless. The VIX has been on the rise, trading at more than 18 handle, brings you at a VIX today above the levels you're seeing VIX futures in May trading, and the 10-year yield hanging out at around 461, a little bit of a bid in the bond market, but not all that much. Stick with us, more ahead. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Time now for the Wall Street beat. Paramount shares are popping as Apollo and Sony are said to consider a joint offer. Paramount is currently in an exclusive negotiating period with Skydance, and the decision is mostly up to the Redstone family, who owns less than 10% of Paramount, but controls 77% of the voting stock. Let's discuss this with Chris Palmieri of Bloomberg News. Chris, let's talk about the offer, the Apollo-Sony offer. To begin with here, how much does that give the Apollo team?
It definitely gives them a lot more credibility, not that Apollo lacks in that, but it's been very interesting to watch Apollo. We broke the news that they were interested back in January, but then things got cold for a while. We had heard that they actually weren't moving forward. Things escalated with David Ellison and Paramount. Then Apollo made an offer just for the film studio, which was something the Redstones did not want to do, break up the company. Then I'd also been told that they just didn't feel there was enough, that it was a solid offer when Apollo made an offer for the whole company, $26 billion, including debt. And so they've been in this exclusive period with David Ellison. But this, adding the Sony element definitely creates a more credible alternative. And investors are not happy with the terms that they're hearing from the Ellison offer.
So how much does it really give Apollo credibility in terms of financing?
In 5 minutes time now at the top of the hour, you see the release of the weekly Baker Hughes numbers. Oil rig count, the prior was 506. Total rigs, the prior was 617.
Well, we had a story up today that sort of really looks at this whole process. Securities law, and has been moving even more in this direction, wants to give, even if you're a non-voting shareholder, which Paramount has a lot of, they say that those folks should get a voice in a big transaction like's being talked about. Now, there's nothing in Paramount's bylaws or in the law explicitly that says the Redstones can't just continue to exercise their power as the controlling shareholders. So they're not required to give everybody a vote. But if you've watched the way the stock has traded, the A shares and voting shares have gone up since all these merger talks have happened because the Redstones own most of them and they would get bought out. And the B shares, the non-voting shares, have gone down for the most part until the big bump today because investors are concerned that a deal with the Ellisons is going to dilute them dramatically.
Chris Palmieri of Bloomberg News. We have to leave it there, though I wish that we can keep going. I'm very curious to know what David Ellison is up to right now. Now, quick check on the markets before we let you go, because we've seen a sell-off underway today. Of course, we're only down about 0.6% on that S&P 500, but more than that on the NASDAQ 100, and of course, the longest losing streak in the S&P 500 since we've seen in October of 2022. Of course, yields have been on the rise all week. Stick with us, though, through the close. That does it for Bloomberg Markets today, and this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia.
So we're shortly expecting the results of the U.S. Baker Hughes rig count. On release, we'll lead with the oil rigs.
From our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Funding for Ukraine and Israel set to pass the House this weekend. Welcome to the fastest show in politics.
Total recount 619, 619.
Important hurdle today that will set up votes tomorrow. I'm Joe Matthew alongside Kaylee Lines in Washington. And Kaylee, once again, Mike Johnson is getting a huge boost, actually able to get things done with the help of Democrats, as so many conservative Republicans oppose this plan.
Yeah, 316 in total voted to advance this package, which will set us up for final passage on Saturday. More Democrats than Republicans voted for this. Now it's going to be a question of whether Democrats also might need to stand up to protect the speaker, as there is now a third Republican who has signed on to the motion to vacate, as Congressman Paul Gosar of Arizona joins Tom Massey and Marjorie Taylor Greene.
And oil rig count 511, 511.
Addition here, because the Freedom Caucus met last night and decided they didn't want to pursue a motion to vacate. They're concerned about the devil you don't know, whether it's Steve Scalise, Tom Emmer, a more establishment-oriented Republican who doesn't share the same values. So you wonder if this is just bluster or if we see something happen here.
Yeah, and of course they're also considering that this is an election year and it could potentially have political blowback for the Republican House majority. And of course all of this progress on foreign aid passing through Congress comes against a backdrop of maybe some degree of escalation in the Middle East as Israel strikes back on Iran, but in a limited fashion. We're going to have more on the latest with our very own Nick Wadhams here in just a minute. First, though, as always, we got to get a check on the markets with Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much. What a week this has been. Another down day, 6 in a row if you're counting. And yes, we are here at Bloomberg for the S&P 500 index down 26. We are below 5,000 at 49.84 right now. We are looking at a loss of just about 0.5% on the S&P. Dow Industrials up, however, up by 191 points, up 0.5%. NASDAQ also in the red. Big tech sinking today. We've got the NASDAQ Composite Index down 1.5%. Amidst all the gloom, however, small cap shares are advancing. Russell 2000 up today by about 0.1%. Your 10-year checking in at 4.61% with a 2-year now yielding 4.97%. Spot gold is trading higher by $21 the ounce, almost 22, up 0.9% right now. 24 even on the precious metal. West Texas Intermediate crude advancing today by 1%.
Bank of England's man says the clear concern is fragmentation impact on inflation.
1% right now. 87.60 for a barrel of WTI. Bottom line here, a lot of traders refraining from making riskier bets ahead of the weekend amid all those geopolitical uncertainties. Tesla shares, they are down right now. We've got Tesla trading lower today, down 0.7%. Tesla recalling almost 3,900 Cybertruck pickups to rework or replace accelerator pedals that can dislodge and cause the vehicle to unintentionally accelerate, increasing the risk of a crash. Again, Tesla shares, they're down now by just about 0.8%. Again, recapping, stocks are trading mixed. S&P down again today below 5,000. S&P down 25, down 0.5%. Balance of Power continues. The Friday edition. Back we go to Washington. Joe Matthew and Kaylee Lines.
All right, Charlie Pellet, thank you so much. Charlie there, Joe, talking about markets reacting to geopolitical risk. As we did see overnight, something we knew might coming, some form of Israeli retaliation. The Iranian strike of last weekend, more than 300 drones and missiles were sent Israel's way, largely intercepted. Much more limited drones sent to Iran, and also Iran says this attack was unsuccessful.
Yeah, we saw a little spike in oil prices on that, not a shocker there. We spoke earlier today with Mick Mulroy, who's the former Deputy Assistant Secretary of Defense for the Middle East. Kaylee, he described this as de-escalatory. The sort of restrained nature of this, kind of a warning, if you will, that we can get inside Iran if we want to, but we're not going to cause any damage today. It might be enough to put this to bed for a moment, but we'll have to give this some time. Something Nick Wadhams is covering for us. He leads our national security coverage here in Washington, and we've talked a lot about this in advance of the retaliation. Nick, what do you make of this now that we've actually seen Israel respond? Is this it? Was this just the reminder to Iran that, in fact, it can infiltrate Iranian territory without their knowing?
Right. I mean, you know, it was an extraordinary situation last night because we started to see these reports that there had been an Israeli attack and then quickly confirmed them from U.S. officials telling Bloomberg that, yes, it was, in fact, an Israeli attack. But then we all sort of paused a beat to see, well, what was coming next? Or were we going to get an announcement from the White House? Were we going to get an announcement from Israel? Were we going to get a damage report? You know, we were sort of anticipating, in some ways, this big response to that Iranian barrage that saw 300 missiles and drones hit Israel in obviously very public fashion. But then it was just silence. The U.S. issued no public statement. Secretary of State Tony Blinken declined to confirm it when asked about it at a press conference today. Also silence from Israel, in keeping in some ways with their past practice of looking to operate in the shadows here. But what we do know now, based on conversations with intelligence sources, is yes, this was designed to send a very specific message. You look at the area where Israel struck Iran, around the city of Isfahan, the site of one of its biggest drone manufacturers, and also, not incidentally, believed to be the site of some of Iran's nuclear work. So very much a demonstration there by Israel that, listen, we have the will to strike you when we need to, but we do not want to start this escalatory spiral that could provoke a wider war. That's the interpretation so far we're hearing.
All right, Bloomberg's Nick Wadhams, who leads our national security coverage, thank you so much for giving us the latest. It's obviously much to keep track of, Joe. And he did mention that we did hear from the U.S. Secretary of State about this, not directly commenting on the attack, but speaking more widely about the state of play in the region at the G7 meeting in Italy. Here is the Secretary of State earlier today.
First, the G7 condemned the unprecedented Iranian attack on Israel. Unprecedented in scope and scale. Scope because it was a direct attack on Israel from Iran. Scale because it involved more than 300 munitions, including ballistic missiles. We're committed to Israel's security. We're also committed to de-escalating, to trying to bring this tension to a close.
That was Secretary of State Antony Blinken speaking at the G7 alongside many other U.S. allied countries, including some from Europe. And so we want to get more perspective now from the European Commission. Valdis Dombrovskis is joining us now here in our Washington, D.C. studio on Bloomberg Television and Radio. He is the European Commission Executive Vice President for an economy that works for people. Sir, thank you so much for being here with us today. If we could first begin, given the developments overnight in the Middle East, knowing that you primarily look at the economy, how concerned are you about possible escalation from here and the impact that that could have on energy prices, which we know has been highly problematic for the European economy in years past?
First of all, we see that the world economy is proving to be resilient despite a difficult situation and different geopolitical tensions and conflicts we are currently experiencing. And also the impact on energy prices so far has been quite limited. Obviously, we need to monitor closely all of those developments, but the assessment is that the risks to the economic outlook are now broadly balanced.
You've been in Washington here meeting with lawmakers about the big story that we've been talking about here for months, Mr. Executive Vice President, and just today we saw an important procedural vote pass for funding for Ukraine, Israel, and the Indo-Pac region. You're obviously very concerned about funding for Ukraine. What did you tell
When asked if recent yen moves justify foreign exchange intervention by Japanese authorities, IMF's Japan mission chief said she firmly believes G7 nations, including Japan, are committed to flexible FX regimes, and says the Bank of Japan will likely have room to raise interest rates further, though future tightening must be gradual and data-dependent.
So far, we have provided support of around 100 billion euros. We now have 50 billion euros Ukraine facility for the 4 years, 2024-2027. We are already disbursing from this facility. So it's important that also other international donors, and first and foremost US, come also with their contribution. And therefore, I'm very much look forward for tomorrow's votes. And hopefully this Ukraine support is being approved, because what we see is that in last months, actually the situation in Ukraine is deteriorating for the lack, especially of military support. We see it both at the front line, and we see it with daily shellings of Ukrainian cities, residential areas, critical infrastructure. So this support is very much needed. I would say the collective West has all the necessary resources to stop Russia, not to allow this shelling to take place. And so hopefully this period of undecision and deterring is coming to the end, and we will be able to come with a strong and firm response to Russia, and also to other autocrats around the world, because it's also not only about Ukraine, it's about our collective security.
Well, sir, as you outlined there, the amount that Europe already has contributed to the Ukrainian cause, it's worth pointing out that there is at least a faction of thought here in the United States that thinks Europe is not carrying as much weight as it should be. One of them is the presumptive Republican nominee, former President Donald Trump, posted on social media yesterday, effectively, to summarize his words, saying that Ukrainian survival is more important to Europe than it is to the U.S. So why is Europe not giving more money to help Ukraine? Why can't it equalize or match the money? This is a quote put in by the United States of America. Is there more that Europe could be doing, sir? I wonder what your response would be to Donald Trump.
Well, first of all, facts has never been the strong side of Donald Trump, and it's also, unfortunately, this time the case. So that's why I'm emphasizing so much the financial aid EU has already provided, which is 100 billion euros in all kind of support. The Ukraine facility, which is already in place, of 50 billion euros. So the fact is that EU is the largest donor to Ukraine, and we are willing to continue this way, because after all, indeed, it's a war on Ukrainian, on European continent. But of course, it also requires solidarity from the broader democratic world, and with EU and US being strategic allies, US support is not only financially very important, but also as a signal of West being united against this Russian aggression.
Of course, Donald Trump's view reflects the view of some Republican members in the House who are voting against this package. I wonder, when you met with lawmakers this week, what was your reception? Did you hear pushback? Did you hear criticism, or were you well received with the lawmakers you met with?
Well, I would say views were definitely varying on this topic, but my point was really to make the case why it's important not only for Ukraine but for entire global security architecture, because what we are seeing is that also other autocrats are seeing, if the West is not even able to contain Russia, that they're also having ideas, and the recent Iran attack against Israel is just another manifestation of this. So from that point of view, it's important to stay firm and determined. Another one, indeed, to make this point on the EU's contribution so far, to really show that EU is doing a lot. The EU is actually doing more than the United States. We're happy to continue to do so, but everyone has to contribute.
Well, of course, sir, your conversations here in Washington have not just been limited to lawmakers. You are also here while the IMF World Bank meetings are underway. And I wonder, from an economic lens, what you are hearing in the messaging and what message you are providing about the state of the European economy right now, knowing that for now policy is still tight and there's questions around when it will ease and where the economy will be depending on when that easing actually happens. How are you thinking about the outlook for Europe? As the IMF essentially said, there could be a soft landing, but there are risks here.
Indeed, as I was saying before, actually the global economy is proving resilient to both current geopolitical tensions and also to the process of disinflation through which we now have to go through. So the expectations for a global growth is of 3.2% of both this year and next. That's IMF's World Economic Outlook. And as regards the EU, we are expecting 0.9% growth this year, 1.7% growth next year. It's somewhat subdued growth right now, one could say, but at the same time, despite a war on the European continent,
shortly expecting the results of the Fed reverse repo operation,
different disruptions we are facing, EU's economy is nevertheless growing.
I want to ask you about another foreign policy matter that you've been concerned with, and that's China supplying components to Russia and potentially evading sanctions. There's an economic element to this. There's obviously a geopolitical element to it. How big of a problem is this becoming?
That's certainly a cause of concern, and there are two elements. One is circumvention of sanctions, but also another is, in a sense, backfilling of the sanctions, and we are engaged with China on both of those elements. So in a sense, what we are doing, we have what we call high priority battlefield items list, meaning items which we are finding in Ukrainian battlefields, in Russian military equipment.
Yeah.
We are tracing the origin of this different kind of components.
Is this lethal weaponry?
Yes, it's Russian military weaponry which is being found on Ukrainian battlefields. And because it's not only about weapons deliveries, there's also many dual-use components. If you talk about semiconductors, all kind of other components. So we're tracing it back where it actually origins, because we must face there's also still quite a few of those components of Western origin which are reaching Russia. So we also need to work with our own companies, both in the EU and US, making sure that they are not engaged in those sanctions circumvention. And in the EU, we also have a possibility actually to go after the companies which are knowingly engaging in these kind of activities. We are putting also requirements on no resell to Russia on exports of dual-use items.
68 counterparties take $397, spot $234 billion at the Fed reverse repo operation.
Also put certain measures against Chinese and Hong Kong companies which are involved in sanctions circumvention by prohibiting EU companies to do any business with them. So there are things which we can do, and it's clear as we are now putting strict sanctions against Russia, EU, US, other players. Russia is looking at the ways to circumvent them, so we need to stay alert, follow the patterns, and to the extent possible close the circumvention and possible loopholes.
Valdis Dombrovskis with The View from the European Commission. We appreciate your making us part of your week here in Washington, and I hope the spring meetings of the IMF continue well for you. Thanks for talking with us tonight on Bloomberg. Kaylee, a lot to cover there as we consider a vote on the Repo Act tomorrow that plays into this Ukraine story in a big way.
Yeah, the so-called sidecar fourth piece of legislation that has not just repo, but also that TikTok divestiture bill. All of that going to be bundled together and sent to the Senate. Chuck Schumer says could be a working weekend for senators too, not just the House. And we'll have more on that with our political panel next on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We got the Dow pushing higher, the S&P off of session lows right now at 4,988, 5,000. Big psychological round number for a lot of investors. The S&P trading below that, down 22 points right now. The S&P down by 0.4%. Dow Jones Industrial Average up 244 points, a gain of just about 0.7%. The NASDAQ Composite Index down 207 for NASDAQ, a drop today of 1.3%. 10-year at 4.62% with a 2-year 4.97%. Spot gold up $19 the ounce to $23.98 for gold, an advance of 0.8%. West Texas Intermediate crude oil up 1.2%, $83.70 now for a barrel of WTI. Lots of earnings news today. American Express shares are up 5.5%. American Express this morning reported revenue that topped estimates in the first 3 months of the year as consumers continued to flock to the company's premium credit card offerings. Amex is known for products like its $695 a year Platinum card. It did announce during the quarter that it would revamp its credit cards with Delta Airlines, the firm's largest co-brand partner. The added perks, though, come with higher annual fees. American Express up now by 5.5%. Again, recapping, we're looking at a mixed Friday here. We're on track for another losing week, another losing day as well. 6 in a row. S&P right now down 0.5% at 49.86. Balance of power continues in Washington. And back we go. Here are your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at a busy day in financial markets today. Thank you. I am Kaylee Lyons alongside Joe Matthew in Washington, where it's also busy here. The House has passed one rule for 4 different measures that they will vote on Saturday. We know, Joe, that this rule had bipartisan support, helping to move forward this $95 billion foreign aid package. I wonder, though, when it becomes a chance to vote for each of these packages individually, Ukraine, Israel, Indo-Pacific, the sidecar with everything else in it, what the vote breakdown is going to look like, and if as many Democrats will show up for the Israel funding.
That's a question.
As for others. And perhaps maybe they're more likely to after what we saw overnight with potential further escalation, though not as escalatory as it could have been as Israel strikes Iran.
Well, and I guess that was the plan here from Mike Johnson, right? He knew that Dems might have a problem with Israel. He certainly knew that his Republican conference had a problem with Ukraine. I don't know what everyone thinks about TikTok at this point. Of course, the House already moved a TikTok divest or ban bill. And so, yeah, the margins might look a little different for each of these. Either way, the Speaker of the House, Mike Johnson, is pretty happy with what he sees here in a rule that passed. It took more Democrats than Republicans to do it, and he talked to reporters earlier today. Here's the Speaker.
It's not the legislation that we would write if Republicans were in charge of both the House, the Senate, and the White House. This is the best possible product that we can get under these circumstances to take care of these really important obligations.
We did the best we could. The message from the speaker as we assembled our panel. Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors. Great to have you both with us here as we actually prepare for voting. Jeannie, let's get to what Kayleigh was talking about here. Are we going to see a sizable number of Democrats vote no on funding for Israel this day after the retaliation against Iran?
Yeah, I think that's going to be one of the curious things to watch. You all were talking about the attack last night. In New York here, a lot of local attention on the protests at Columbia University, where students are asking the university to divest from their investments in Israel. So this is a lot of tension on the ground. We saw San Francisco not that many days ago. So I do think there's a possibility. We do see at least a call to place more conditions on that aid. But I think all in all, in the end, this is going to pass. But with all of these sort of four buckets, if you will, in this larger bill, I think we're going to see some strange bedfellows. And that's going to be one of the dramatic things tomorrow is by how much do these bills or the separate bills pass, assuming all four or at least three of the four seem on their way to passage.
Well, Rick, we know what a lot of the progressive Democrats who take issue with Israel's policy in Gaza have been pushing for is Israel to have more constraint or restraint, rather, in the consideration of the civilian death toll here. They would like them to be more restrained in their operations, focusing more on humanitarian aid. But there also has been a lot of push for Israeli restraint in response to what we saw Iran do last weekend. Has Israel actually heeded that message? Is that what we learned overnight? That, okay, when the U.S. and allies do call for restraint in what could have potentially been a very escalatory incident, Israel seems largely to have done that.
Yeah, I think that would be our guess. The fact that Secretary Blinken did not criticize Israel today for any of their actions and actually was pretty quiet about the entire incursion. I mean, like, Israel launches a drone strike in Iran. Any other day, that would be above the fold headline creating a global crisis. Now it almost seems like, oh, thank God they did that. And I would say the only criticism that I've seen of any real value is within Netanyahu's own war cabinet, and he had some of his top allies in his coalition say this was a weak attempt at a response, and so he was balancing the conservatives in his coalition with the needs of his people and the global attitude toward a broader conflict, and my guess is they probably figured this one out. I mean, the question now is this the end of this sort of messaging phase where, Iran sends a message to Israel, Israel sends a message to Iran? I mean, these aren't really calculated as diminishing capacity on either front. It is really to send messages. And so are we done with the messaging phase, and can we move on now to a more constructive dialogue around the humanitarian crisis and what's going on in Gaza? And there's a big chunk of change in this supplemental package to address some of those humanitarian needs, almost $10 billion. And so this could actually be an incredibly good weekend for the president, because he can look at this and say, I got the supplemental that I basically wanted, and I have a calmer Middle East to where we can actually step off and start finding solutions to the death toll in Gaza. And, if he can get that done, that's a pretty good week of work.
Fair enough, Jeannie. I wonder your point, or your view on Rick's point. Officials were clear here in the U.S. last night that they did get a heads up by Israel, but they wanted to make the point that the U.S. did not green light the response. Does that make a difference to progressives who are already angry at Joe Biden about Israel?
I'm not sure it's going to make that much of a difference politically. I think Israel showed an awful lot of restraint, as Rick was just talking about, in the aftermath, as well as did the administration. I think all sides, or most sides, are hoping that this is the end of it, that Iran doesn't decide to retaliate and the de-escalation was achieved. But I will tell you, some of the reporting we're hearing is the kind of thing that makes people on the left concerned and feel that there is doublespeak, as some people call it, coming out of the administration. And this is the reporting just now that the Biden administration is considering sending tanks, mortars, vehicles to Israel. This is the kind of thing where people on the left say they don't really care what the, sort of muted response was to last night. The fact that their government is still supplying and the civilian situation and the number of casualties and the humanitarian crisis continues is what is the source of a lot of this frustration and angst. And so, that's where I think the political end of this is going to show up. And I think Joe Biden, as usual, is having to walk a really tough tightrope on this. We heard Blinken supporting Israel and our closest allies and condemning Iran's attack last weekend. But of course, that has done little to assuage the critics on the left. So it's a very tough moment for the administration on all of this.
Yeah, of course, because you're not just an incumbent president and administration, but also trying to actively campaign for president and want to get reelected in November, which just makes this all the more complicated. And of course, the man Biden is running against, the presumptive Republican nominee, Rick, is spending his time not so much maybe focused on geopolitics, although certainly he has been weighing in on Truth Social, but spending a lot of time, including today, at a courtroom in New York. We do now have the jury seated. 12 jurors have been selected, 1 alternate. We're looking for 5 more, but it does seem like the jury selection process could wrap up in the not-so-distant future, and we could potentially be getting into opening statements next week. Rick, how consequential is it going to be when voters start to hear details about an alleged affair between Donald Trump and a porn star and everything that has happened in the aftermath?
Yeah, I think there's been so much written and talked about that Donald Trump has taken advantage of these court cases and that he's raised money off of them and he's turned them into political events. I think he starts to feel the pain when all the details start coming out about, his illicit relationships, with not just the porn star, but also a Playboy model. He's got his own people who are going to testify. Hope Hicks likely will be on the stand. Michael Cohen, who's gotten a lot of press about this. This is going to be horrible. I mean, there's no campaign manager on the face of the earth that's going to look at next week and say, this will be great for us. I think we can really win a lot of votes this way. It'll be damage control. And we see them trying to do that by putting people like President Duda in meetings with the president to try and change the topic. But there's only so much you can do while you've got a court case going on all day.
David Pecker is another name as we hear about this operation. I forget the name of the thing, Kaylee. What do they call the hide and seek, whatever it is that they had going there to basically snuff out stories that were detrimental to Donald Trump by buying off some individuals here. Catch and kill, Elizabeth. Thank you for helping me out. That testimony could resonate more than some of the others, Jeannie. How will it play?
Oh, I think I agree with Rick on this. I think it's going to be very tough. I was just talking to a group of young people not that long ago who don't watch all that closely, and they just scratch their head at the idea that he is in the first of 4 criminal trials. Even those who support him and say, how can this person run for office and potentially be the next president? So I think next week is critical because all of this we've been talking about these trials comes home to roost, and people actually see the reality, which is that person so close to the White House may indeed be found guilty of 34 counts in a criminal trial.
All right, Jeannie Shanzano and Rick Davis, our Bloomberg Politics contributors, thank you both so much. And just to bring you the latest on Trump's hush money trial up in New York, all 6 alternates have now been selected.
Wow.
So we have a full panel of alternates and jurors for this case, Joe.
Opening statements on Monday. Isn't that what that means?
Potentially. They do have a half day Monday and Tuesday for Passover, but next week it looks like it could happen.
Remarkable.
So there's some news for you. Let's get some more world and national news now with Amy Morris in our 99.1 newsroom here in Washington. Washington. Hey, Amy.
Hey, Kaylee. House lawmakers are also working this weekend. They're going to hold a series of votes on the foreign aid package to Israel, Ukraine, and Taiwan, and a measure that would force TikTok to separate from its parent company, ByteDance. The legislation cleared a procedural hurdle in the House this morning, gaining enough votes to advance. House votes are expected to begin around 1 o'clock tomorrow afternoon. The Senate votes are expected next week. Tensions escalating in the Middle East after Israel had launched a retaliatory strike on Iran less than a week after Tehran's rocket and drone barrage. Secretary of State Antony Blinken at the G7 summit says the group of nations is urging de-escalation.
The G7 statement makes clear that G7 countries will adopt additional sanctions or other measures in the days ahead.
Iran says the attack was limited in scale and did minimal. Hours a day whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow Jones Industrial Average continuing to hold on to a gain. However, the S&P, NASDAQ 100 index all very much in the red right now. We are looking at a drop of 0.6% right now on the S&P, trading below 5,000 at 4,982, down today by 28 points. The Dow up 207, up 0.5%. The NASDAQ Composite Index down 237. For NASDAQ, a drop right now of just about 1.5%. So the stock market getting pummeled as the world's largest tech companies sold off. Traders also shunning riskier assets ahead of the weekend amid geopolitical uncertainties. The 10-year, 4.62%. The 2-year, 4.97%. Gold is advancing $18 the ounce to $23.97. That's a gain right now of 0.8%. West Texas Intermediate crude oil up 1%, 83.53 a barrel. Brent, the global benchmark, up 0.6%, 87.63 right now for a barrel of Brent crude. So the Dow, the S&P, NASDAQ trading mixed right now. In the meantime, sources tell Bloomberg Morgan Stanley has added Andy Lipsky, J.P. Morgan Chase's vice chair of investment banking. He's set to join the New York-based bank in coming months in a similar capacity, according to one of the sources. Recapping, stocks mixed. S&P down 28, down 0.6%. The Dow up 0.5%. Balance of power continues now from Washington. Back we go. And once again, your hosts, Joe Matthew and Kaylee Lyons.
Charlie Pellet, thank you with Friday trading for us. Welcome to Bloomberg TV and Radio. This is Balance of Power, live from Washington, with actual news on Capitol Hill. They passed a rule. That should not be news. But after rules failed 7 times already for this speaker, it was a big deal to see Democrats line up behind him, a few more than Republicans today, to pass the rule that will allow all these separate funding bills to be stitched together into a single body and sent to the Senate. The line from Thomas Massey, one of the Republicans, now 2 who have joined Marjorie Taylor Greene with her motion to vacate, says it all. He takes to Twitter, "The U.S. House is now officially in an alternate universe where the Speaker shares procedural power with Democrats." Kaylee Lyons, is that not true at this point of the game?
Well, I guess effectively, if you need Democrats to get everything over the finish line because you can't get enough Republican votes,
yeah,
and you might need Democrats to save your gavel if this motion to vacate actually is acted upon by Marjorie Taylor Greene and her 2 buddies in this effort, then yeah, you rely on Democrats at the very least. Do we go all the way and say this is a coalition government?
Yeah, but it's maybe not a formal power sharing agreement.
Right.
But
maybe that's one step too far, but maybe we're not far from it.
Mick's going to pull us in from the ledge on this.
Is he? Mick Mulvaney, the former Republican congressman from South Carolina, and of course, former acting chief of staff under the Trump administration. He has a litany of other titles as well. Mick, always great to have you here on Balance of Power. What's your take on what's happening in the House and the extent to which Mike Johnson is not relying on his own party, but the other to get his job done?
Hey, Kaylee, Joe, it's good to see you guys. I was actually sitting here just jotting down some notes as you were doing your little intro, and the word I wrote about 3 times was exactly what Kaylee just said. This is a coalition government. That's exactly what this is right now. And let's geek out a little bit, shall we, on House procedure, if that's okay?
Yes.
This is kind of a geek, right? Rules are supposed to pass on party lines. And when the Speaker's committee, and the Rules Committee is the Speaker's committee, the Speaker puts all the Republicans on that particular committee. When that committee cannot pass a rule out, and you have to rely on the Democrats, then you are now in a coalition government. You're now passing stuff that is acceptable to a majority of both Republicans and Democrats, a coalition-style government. Keep in mind what a rule is. Because of the arcane way that the House of Representatives works, there aren't really any rules until you set a rule for every single piece of legislation. That rule includes when it will be debated, how long it will be debated, who gets to speak and for how long, which amendments will be in order or allowed to be debated and voted on, etc. Without that, you have to do what you guys mentioned in the intro, which is do a suspension of the rules, which is essentially just bring something down and see if 2/3 of the people support it. If so, it passes. This is, again, a bizarre way to do business, but it's the way the House has worked for generations. When the Republicans need the Democrats, or vice versa, to pass a rule, which is what you have to bring a bill to the floor where it can pass with a simple majority, you have a coalition government. And that's what's functioning right now in the House.
Well, that's remarkable. I thought you were going to say, come on, guys, give them a break. This isn't a formal power-sharing agreement. But we read you, Mick, and I guess I'm just wondering what happens next then. If this is, in fact, a coalition-style government, whatever we're going to call it, that would also protect him from being fired, right?
Well, that's the test, right? I mean, I don't know if you all saw what Kevin McCarthy said. I can't remember what the outlet was last week. He said he thought that he had an understanding from the Democrats that they would come to his aid. Right. Which is why he said reach out, because he didn't want to spoil his relationship with his own party. And it might be that Mike has something formal, something informal. It might be Mike thinks they're coming to his aid, but we won't really know until the vote happens. And that's why, let's get to the interesting stuff, right? The vote to vacate the chair is a privileged motion. So anybody, now that it's been filed and it's ripened, it's sat in the hopper for X number of days, it can be brought up at any time by anyone. And once it is, it stops all other activity. So if Marjorie Taylor Greene and Thomas Massey are sincere about trying to stop what's happening on the floor, they could, in theory, not in theory, they could actually bring the motion now and bring the House to a halt, at least temporarily, while they vote, or semi-permanently if it passes until they hire a new speaker.
Well, Mick, I think it's interesting that some of those who cast a vote to oust Kevin McCarthy last fall are suggesting that they would not do so again this time because they have serious concerns. Either it's going to hurt the Republicans electorally come November, or because there's a real chance that Hakeem Jeffries could end up the House Speaker. What's different now that wasn't true when we were dealing with Kevin McCarthy inside the Republican Party, including the House Freedom Caucus? Bob Good does not seem to want to go along with us. Can you just try to take us inside that room and work through what you think they might be thinking?
Yeah, I think some of the folks are starting to realize what poor decision-making they may have made when they removed Kevin McCarthy. They sort of brought this stain on the reputation of the Republican Party and didn't get better policies out of it anyway. So I think they're scratching their heads going, maybe all those people like Mulvaney who are saying this is a stupid move might have been right. By the way, one of my favorite sayings is that the biggest lie in Washington, D.C. is, I hate to say I told you so. Everybody loves saying I told you so in Washington, D.C. But I think a lot of folks are starting to realize that. I wouldn't diminish the role of Donald Trump here. I don't think Donald Trump, and that's the reason you saw him with Mike Johnson this week, or last week, I guess I lose track of time, was because he doesn't want this distraction. Okay, he wants the negative focus that's on Biden now about the economy and Biden's inability to navigate what's happening in the Middle East, and he wants the attention on his trials, which he is using now to his political gain. If the Republicans replace a speaker or move to replace a speaker, that goes to the top of the media list, and it kicks him down one, maybe two notches, and he doesn't like that. So I think it's a combination of things, but keep in mind, and we had this conversation, Kaylee, with John Boehner the day before he retired. He called a bunch of us into a room and said, or I think it was 6 or 8 of us, and said, are y'all going to bring the motion to vacate? And because it had been sitting there sort of like it is now for Mike Johnson. And we said, Mr. Speaker, no, we won't. We'll give you our word on that. But if anybody else does, we are going to vote to vacate the chair. And that's the question right now is, are those folks out there who are saying, I don't want to change the speaker, let's not change the speaker, now it's bad for the party, et cetera. If the vote actually comes down, will they vote to keep Mike Johnson in there, or will they vote to vote him out?
Well, it's really something. As your former House Freedom Caucus weighs in on this, to Kaylee's point, they met last evening and decided that this motion to vacate was a bad idea. Mick, is it about the devil you know? The Freedom Caucus doesn't want a Steve Scalise or a Tom Emmer to replace Mike Johnson, or, God forbid, in their view, a Hakeem Jeffries, right?
I don't think the Hakeem Jeffries' possibility is for real, but there might be a compromised person. But I think the bottom line is this, is that I think they've now realized that the things they didn't like about what was happening under Kevin McCarthy's speakership was not because of Kevin McCarthy. It was because they have a 3 or 4 or 5 vote margin, period. That's it. And replacing Mike Johnson with any other Republican is not going to change any outcomes at this point. Nobody who they can imagine in their wildest dreams. Keep in mind, Mike Johnson was praised by the right wing when he took over as speaker. He was their win. I remember the right wing groups claiming that this is what it was all about. It was worth it to get rid of McCarthy because look at the great conservative and things are going to be different now. And yay team, and we were right. And now they're sort of looking their hands over and go, well, maybe it wasn't a personality driven thing or an individual driven thing. Maybe it was systemic. And I think that's correct. This is what you get when your majority is only 4 or 5 people. And I think now some of them are starting to realize that.
Mick Mulvaney, great to see you, Mick. Thanks for coming back to talk to us. We'd love to connect next week once this is all done. Co-founder of the House Freedom Caucus, of course, former congressman and former acting chief of staff in the Trump administration. Pretty remarkable, Kaylee. By this time tomorrow, we expect to have voting underway and a much better sense of how Democrats and Republicans are going to fall on this. And it all comes against the backdrop of this response from Israel against Iran, which really a week ago, the attack by Iran, I think we can acknowledge, really set the fire here to get something moving again. We thought we might be waiting months more for this to happen. And there's a big market reaction to what we saw there as well. As we turn our attention to our friend and colleague, David Weston, the host of Wall Street Week, who will be coming up a little bit later on today with the program. David, it's great to see you joining us from New York. How much of a market risk is what we saw last evening? Because since we've come on the air, we've had repeated analysts tell us that this was a de-escalatory move by Israel in the way they chose to execute this.
Well, we certainly can hope it's a de-escalatory move. I dare say we have to wait till the whole thing's over till we really know, because this can take all sorts of twists and turns. But I mean, over in the Middle East, we have something that even puts the House of Representatives to shame, and the conflict and complexity of it, which we have going on. So we brought on Richard Haas this week to ask him, and not just because he ran the Council on Foreign Relations, but you may remember he was Colin Powell's chief policy guy during the Gulf War back in, and then before that in the National Security Council in '91 under George Herbert Walker Bush. So he's seen a fair number of these, and he tried to lay out how much more complicated the situation in Israel has become. This is part of what he had to say.
You've almost got a Middle East now that's operating along different fault lines. The Israeli-Iranian one directly, what's happening in Gaza, what's happening in the north, which has gotten worse in the last few days between Israel and Hezbollah.
Many of us follow the news carefully, whether on TV or reading the New York Times, Wall Street Journal. But much of what's going on we don't see. It's below the surface work. You were part of that when you were in the State Department with Colin Powell. You've been in those rooms. Give us some sense of what you think may be going on that we don't know about, and particularly what the U.S. role is or should be in this.
Well, the big thing is the U.S. is trying to be reassuring to Israel. At the same time, they're trying to urge them not to respond against Iran. The parallel here, David, is when I was at the White House in 1991. It was the opening days of the Gulf War. Iraqi Scuds were landing on Israel. And we, the Bush administration, Bush 41, prevailed upon the Israelis not to retaliate directly against Iraq. We were worried that could break apart this coalition we had built. But we were in a very strong position then. We had 500,000 American men and women in uniform over in the Middle East. We were at the center of it. The Biden administration does not have that kind of influence over Israel right now. So I think its hand is somewhat weaker.
Yeah, so that's Richard Haas from Center View Partners. And he said the United States in some ways is weaker. But in my old law firm, I had a partner who used to talk about the green poultice, that money will actually get you a fair distance. And it looks like right now one of the issues that the President Biden and his administration are putting on the table is yet more armaments, more support for Israel. That always helps, it appears, to have some influence, even over Bibi Netanyahu.
Yeah, well, of course, we could see billions of dollars in more support for Israel approved this weekend in Congress, as the House will vote on a package that does just that, in addition to everything else. And David, it's interesting to think through how convoluted this seems to be for financial markets, knowing that recently we've had to readjust to the entire narrative really around inflation, that perhaps it's going to be stickier than thought, and therefore rates will stay higher and longer. So they're hypersensitive to anything that could indicate a further inflationary spike, like, say, energy prices. How are you seeing Wall Street making sense of all of these different headlines and trying to figure out how geopolitical risk needs to be hedged or not?
Well, Kelly, more important than what I'm seeing is we have Steve Ratner on, who manages Mike Bloomberg's money, the founder and majority shareholder, as well as Peter Krause from Aperture Investors, who's been an investor for some time. And we asked both of them that very question because we saw at the beginning of the week, remember, we came in thinking, oh, goodness, the markets are going to be really in a tizzy because of that attack by Iran on Israel. And then they sort of sorted through it and got back to worrying about what Jay Powell thought, right? And now we're at the end of the week, and it looks right now, but it's too soon to say, we're seeing a similar version of that. So the question is, how do the markets really discount that? I think you put your finger on it. A lot of people, and Peter Krause says this specifically, it's a question of, does it really affect the price of oil? Thus far, the price of oil, has gone up and then it's come back down. If it really has a long-term significant effect on oil, then of course that changes the world economy in a whole host of ways.
David, you talked about the impact funding could have here politically, diplomatically, in our relationship with Israel. Does the market care about what's happening this weekend? Does passage of these bills have a settling effect on any level geopolitically?
I don't know. We'll have to wait and see. I don't think it's as big as what Jay Powell is thinking about, to be perfectly fair with you. Whether that's right or wrong, that seems to be what the markets are focused on right now. At the same time, I think the markets do like to have it sort of steady as she goes. And supporting Israel is a steady as she goes move. Frankly, supporting Ukraine at this point, whether you like it or not, I think President Biden has done quite a job of keeping this coalition together with the Europeans. And if there was a real right turn or a left turn that was dramatic in either place, I suspect the markets would react to that. They don't like the unexpected coming around the corner.
All right, David Weston, host of Bloomberg Wall Street Week. Thank you so much, and looking forward to the program. You can, of course catch that at 6 p.m. Wall Street time, as you can every Friday. Joe and I will be back just before that at 5 p.m. for the late edition of Balance of Power. And in the meantime, stay tuned here on Bloomberg Television and Radio, because Bloomberg Business Week is coming up in just a few minutes. This is Bloomberg.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
They're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
DOJ or other authorities.
Could face bigger challenges. Britain's next.
Fed was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody, live on radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week on this Friday, April 19th. Let's get to the setup. And Tim, we've got U.S. stocks on track for a third down week. We're talking about the S&P 500 dipping below that 5,000 mark. We're down 6 in a row. That is the longest losing streak since October of 2022.
Yeah, the Mag 7 just getting crushed right now. The trade certainly front and center for us this Friday. Also front and center, Carol, the stress from geopolitics as well as concerns closer to home.
Yeah, so we're going to get into the moves in Congress when it comes to aid to allies. Also, why the West may need a reset on one of the world's wars. We're going to get into this. This is a Bloomberg opinion piece that definitely grabbed our attention today.
We're also talking about the Federal Reserve because another stress point is the Fed resetting the clock when it comes to those rate cuts that were expected this year.
Yeah, speaking of stress, check out Netflix. Investors in Netflix feeling some stress as well. Investors tuning out of that stock. You've got the stock down the most in 2 years, weak revenue forecast, one of the reasons why, and that plan to stop sharing subscriber numbers. It was something that when it crossed after the close yesterday, we were all like, wait, what?
Yeah, I mean, less data is never good for analysts who are trying to track the stock, certainly. Also, on a lighter note, why, oh why, are all those private jets leaving New York City just minutes before midnight?
I gotta say, this is the most read story in the Bloomberg all day today. All right, first up, let's get a check on the day's trade as we get ready to wrap up the day and the week. Here is Charlie Pellet.
Thank you very much. Happy Friday to you both. We have got the Dow Jones Industrial Average right now below 38,000. If we're talking big round numbers, cannot ignore S&P 5,000. We are below that threshold right now. 49.79 right now on the S&P, down 32 points, a drop right now of 0.6%. NASDAQ lower by 244 points, down 1.6%. A sell-off in the world's largest tech companies hitting stocks hard. Traders also shunning riskier assets ahead of the weekend amid those geopolitical uncertainties. Got to keep it locked into Bloomberg Radio right through the weekend for the very latest. S&P, as I mentioned, down 32, drop there of 0.6%, but perhaps the other number that counts, 49.79, back below 5,000. 10-year right now, 4.62%. The 2-year, 4.97%. Spot gold up $14 the ounce, up 0.6%. And West Texas Intermediate crude up 0.7%, 83.30 for a barrel of WTI. Netflix, a stock we will be discussing today. Netflix shares tumbling as a weak forecast for revenue and a warning that the streaming giant will stop reporting subscriber numbers in 2025, overshadowed an otherwise strong start to the year. Netflix right now down 8.5%. Recapping, stocks lower, S&P down 0.6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So listen, we're focusing a lot on the equity trade today, but really what we've talked so much about throughout the week, and the reason that we've seen some volatility creep in once again on the side of U.S. stocks and certainly putting pressure, we're seeing that in the week overall, is that what we've seen, Tim, overall this week when it comes to U.S. rates.
Yeah, U.S. rates have shot higher, Carol. In fact, yields on the 10-year this week, moving to levels not seen this year, all the way going back to November of 2022. So certainly has to do a little bit with the way that people are thinking about the path of the Federal Reserve.
Yeah, exactly. So it's kind of like tick-tock, everybody, because that is the sound of the Federal Reserve basically resetting the clock when it comes to what they want to do with interest rate cuts, putting them off longer, as we know. Chicago Fed Bank President Austin Goolsbee among the latest to weigh in today, saying the U.S. Central Bank, Tim, needs some more time.
Writing about all of this in a week two when we heard from Fed Chair Jay Powell, who confirmed we are indeed, yes, higher for longer. On rates is Bloomberg News Federal Reserve and economics reporter Katerina Saraiva in our Houston bureau. Katerina, a great piece that really ties together kind of everything that we heard this week with Powell, the moves on rates. We know the drill, the Fed data dependent, and yet Fed Chair Jay Powell cementing the message this week that led to the reset of the clock cutting rates, as you write. Why do you think there was a significant shift this week when we heard from a lot of Fed speakers in recent weeks that, yes, that data has indeed come in a little hotter than we like?
Yeah, well, I think, as they say, it ain't over till the fat lady sings. I think in this case, people are really looking for that guidance from the top. And I think especially getting it from the chair is a clear indication that this is kind of, we're now seeing a shift. And it's kind of has broad support. We've, as you mentioned, heard it from various Fed officials, but now also from the chair. And, importantly, we also heard it from the vice chair earlier this week. And you've heard similar sentiments from John Williams, the president of the New York Fed. So that's kind of your FOMC troika, as they like to call it. So, the leadership is saying it, the others are saying it. So now we can be sure that this is kind of the path forward.
It's like in a household, depending upon parents, like one is sometimes more strict. So it's like, well, mom said this or dad said this. Like it just holds different weight. We know that. I'm not saying one sucks or the other.
Who's Jay Powell in this case?
Jay Powell is just, I don't know, he's both, I guess, right? But having said that, it was significant to have him kind of finally get on board with this idea that, yeah, maybe we are going to stay higher for longer. Having said that, I do feel like there's still a little bit of a drumbeat among Fed officials, Katerina, that we're still going to get a rate cut this year. And I feel like market folks that we talk to say, yeah, probably after the elections is kind of what we're thinking. Has a rate cut by the Fed and Fed officials been ruled out completely?
No, I don't think so at all. I think they very much would like to cut rates this year. And they're also concerned about, what will start to happen on the labor market side of things if they keep rates, too high or high for a long time. So they're being very cautious. I think they would like to cut rates. I think you see, this reaction we're seeing in markets is maybe kind of a bit more extreme than where Fed officials are, right? I think you're seeing now just odds of two rate cuts this year, people pushing it out farther and farther. Some banks now saying that, we might not get any rate cuts at all. But I think for the Fed, the latest forecast we have from them is for 3 cuts. That, we'll have to see in June whether that holds up. But I think they want to see a cut.
A couple of things that struck me in your story, and this one in particular, because we're starting to hear from people saying, and we have actually for a while, no rate cuts this year, and maybe we get a rate increase. You write in the story, Fed officials are increasingly voicing concern high borrowing costs may not be doing enough work to rein in demand, increasing anxiety among investors and analysts that the central bank may need to actually raise interest rates further. It's interesting how the narrative has changed, I feel like, Katerina, in such a short period of time. What guidance at all or commentary have we gotten really that we can kind of hang our hat on when it comes to Fed officials about a rate increase?
So first of all, it's not that many Fed officials that have kind of opened the door to this, but a few of them have maintained throughout this whole process, from when they started holding rates in July, that another rate increase is not off the table. I mean, you've even heard Powell say this. So I think they want to keep options open.
The White House says it has no comment on reports on Israel and Iran overnight.
To one policy course, and it's not good. So they want to keep options open, but it's still a very kind of, fringe idea, if you want to call it that. It's kind of the last option for them. So I think it's still pretty out there in terms of the chances for that, but they're keeping the door open.
So, okay, keeping the door open, it's fringe, it's sort of an out there option, the way that you described the idea of potentially raising rates this year further. I wonder, though, what data you might have to see for you to start saying that that idea is no longer fringe, or we hear from more Fed officials that, okay, we might need to open the door a little wider on this.
Yeah, I mean, I think the inflation data is going to be, really hotly watched from now on. And I mean, it has been already. But I think if we continue to see prints that are disappointing, that are just kind of flatlining or even going up from where we are right now, that's going to really increase concern of that. And then I think other demand activity, right? If you see the easing that we saw in the first few months of this year in financial markets, so if you see, the stock market going up again, maybe Treasury yields falling a bit from these higher levels now, that could cause concern. And then some of this consumer data, right, like the labor market strength, if that just continues unadulterated, if you see consumer spending and retail sales data that continue to come in really strong as it has the past month or so, all of that will kind of add to this picture of the economy isn't slowing as we would like, and it's going to take more action from us being the Fed, not me, but it's that it would take more action from the Fed to really slow things down.
Well, Katerina, we had Matt Boesler on our program yesterday, and he pointed out in a great piece in Bloomberg Business Week about how increasingly we're starting to see a larger and larger portion of inflation data made up of rents going up, not necessarily across the country, but in certain hotspots around the United States. Given that the Fed's tools that it has are blunt instruments, how does it get that part in control when all it can do is, focus on this dual mandate?
Yeah, I mean, it's a really interesting question. And this is something that Chicago Fed President Austin Goolsbee has been talking about, how if you look at the kind of different big components of inflation, goods, services, and housing, the one that really hasn't slowed down much is housing inflation. And so that's concerning. But as Matt pointed out in his piece, that does have some kind of geographic differences, right? You're seeing slowdowns in the South and in the West, but not in the Northeast. So, I mean, I think for them, for the Fed, what that means is just keeping rates higher for longer or potentially raising rates to try to slow it down. I mean, it is a very blunt instrument. And I think that's why at the beginning of this tightening cycle, people were really concerned that we were going to have to see a recession because demand was just so strong. And in things like the housing market, where you have so many other forces at play, right? We have a huge supply issue in this country. So it's really kind of tough to move that needle when you just have the reality of not enough housing for the number of people we have in this country. So I think if we don't see more progress on that front, it is going to kind of bring back some of those questions about, are we really just going to have to break things a little bit or cause more pain to fully bring down inflation?
Well, and Katerina, as you guys point out, or you point out in your story, I mean, the idea that the things that folks are worried about is that it takes so little to kind of stimulate the economy right now. I think we're all shocked, as growth estimates being kicked higher here in the United States. We heard from the IMF about global growth, and we keep having folks on, especially in the investment universe, are saying like the U.S. is doing well compared to a lot of other markets, especially developed markets around the world, when you look at their economic outlook. So, better growth doesn't take much to stimulate. You got to be worried about sparking inflation again. And that's kind of where the Fed is. And I'm assuming at this point, they're going to want to see 2 to 3 to 4, trending lower when it comes to inflation before they're ready to really do something when it cut rates. So that's already, you're talking 3 or 4 months at least from now.
Yeah, I think that's right. And I think that's what we really aim to show in the piece, that the clock has been fully reset now. We've had 3 months, at least with the CPI, of disappointing reads. We're likely to get another kind of flat, maybe up print in the PCE next week. So it really now, the clock is reset. We need another probably 3 months or so of just, data that is where inflation is cooling and not just staying steady or rising.
So, Katerina, let's go back in time a little bit to November, December of this year when we saw what was referred to, I guess, until yesterday or earlier this week as the first Powell pivot. Do you think that's something that maybe the Fed chair regrets or perhaps wishes he wouldn't have done?
Yeah, I mean, I don't know. I think it's so difficult to, in hindsight, go back and say that because the data were looking good. And I mean, to be fair to him, what he said at that point is that, the next policy move is likely a cut, which I think still seems to be the case.
Yeah.
And really, he was working with what he had at that point, right? So.
Right.
It's tough.
It's tough. It's going to be interesting. May 1st, that next FOMC meeting, so certainly a focal point for us. Katerina, thank you so much. Katerina Saraiva, Bloomberg News, Federal Reserve and economics reporter. Hey, now we want to get to something that we are focusing on, geopolitical, what's happening among lawmakers up at the U.S. Capitol. The U.S. House advancing a long-stalled $95 billion aid package for Ukraine, Israel, and Taiwan, a breakthrough signaling an end to an increasingly agonizing wait for Ukraine and U.S. allies in Europe. And I got to say, a lot of stuff continuing obviously to come out of the Middle East. A story that caught our attention is a column by Bloomberg Opinion international affairs columnist Mark Champion, in which he is someone who continues to look at the geopolitical for us from all its angles. But this column he poses, if only the West backed Ukraine as it did Israel. Mark joining us from London. Mark, only got a couple of minutes, but you look at the contrast between Western allies' response to Iran's missile attacks and to Russia's. You say it's time to call ourselves out over Ukraine. Explain that positioning.
Yeah, essentially, what happened is that there's nothing wrong with what the West did in Israel, in my view. I mean, they did the right thing. When Iran, showered missiles on Israel, they got involved in order to defend its airspace and to make sure that there wasn't the kind of catastrophic loss of civilian life that would lead to a regional war. So that's exactly what we should be doing. The issue is that, that was what we were doing in Ukraine, and it was understood that that was what it was about, to make sure that Russia didn't, succeed in its invasion in ways that would leave, triumphant Russian troops across the border from Romania, etc. There would be very significant costs to allowing that to happen. But more recently, since last October, really, the West has sort of dropped the ball, and primarily because U.S. funding for the weapons, the interceptors that are there to stop missiles from landing on Ukrainian cities, it just dried up because Congress refused to release it. And now you have cities in Ukraine that are being hit routinely. Their infrastructure is being hit, their heating's being hit, their electricity power is getting hit, and people, residential apartment blocks are getting hit, and people are getting killed as a result. So the point I was making is that, we're doing the right thing. We did the right thing in Israel. We had done the right thing in Ukraine, and we need to get back to it.
We apologize, Mark. We're running out of time here, but we really recommend everybody check out your column and columns that you can find on the Bloomberg terminal. Mark Champion joining us from London. Hey, when we come back, we talk Netflix with an analyst who is looking for a 30% gain in the stock over the next 12 months. That as the stock drops the most in 2 years today, Tim. That story is coming up next. This is on a day where we're seeing, again, some volatility in the trade.
Yeah, the NASDAQ certainly taking it, the brunt of it today, down 1.7%. The S&P 500 down 0.7%. The Dow Jones Industrial Average up about 0.5 percentage point. Carol, in terms of what's dragging down the S&P 500, it's all big tech, supermicrocomputer, Netflix, Nvidia, and more.
Netflix right now down 8.5%. Folks, you are listening and watching Bloomberg Business Week.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the S&P 500 index right now at 49.79. Got to keep it tuned in to Bloomberg Television and Radio just to find out where we close. Will we end the day back above 5,000? Right now, we are looking at a loss in the S&P 500 index of 31 points, down 0.6%. Dow Industrials up 193 now, up 0.5%. The real damage, though, among tech stocks, the NASDAQ 100 index down 1.6%. The NASDAQ Composite Index also down by 1.6%. 10-year yield 4.61% with a 2-year that's now yielding 4.97%. Spot gold up $16 the ounce to $23.95. That is a gain of 0.7%. And West Texas Intermediate crude oil up 41 cents a barrel right now, 83.16 up 0.5%. Brent, the global benchmark at 87.42. Brent up by 0.4%. So again, we've got the 10-year 4.61%, that 2-year 4.97%. Among the many names out with earnings, American Express, the stock rallying now by 5.5%. American Express reported revenue that topped estimates in the first 3 months of the year as consumers continue to flock to the company's premium credit card offerings. AXP up now by 5.5%. Recapping stocks mixed, S&P down 31, a drop there of 0.6%. The S&P at 49.79. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. All right, shares of Netflix, you know that. Charlie talking about it. We're all talking about it. They are dropping. They're down about 8.3%, the most in 2 years. Shares started tumbling last night. The trade continuing lower into today's trade, following a weak forecast for revenue at the company and a warning that the streaming giant will stop reporting subscriber numbers numbers in 2025. You saw that as soon as it crossed last night. You're like, that's a big deal.
It's a really big deal. I mean, less data, that is not something that investors want. It's not something that analysts want. All of that really overshadowing an otherwise strong start to the year. It's best start to a year going all the way back to 2020, and a blockbuster gain in subscribers in the last period. But subscriber gains, Carol, the company said, will be lower this period.
All right, so let's get to the interview. He was a bear on Netflix for years until he wasn't. With us is Michael Pachter, Managing Director and Entertainment Analyst at Wedbush Securities. He's out there in Long Beach, California. Michael, let's just go to it. Down more than 8%. That sell-off, justified in your view?
It is. I mean, I think Tim said something that probably isn't right. As an analyst, I prefer no information. It actually allows it allows me to share my insights, and investors actually value them more.
Well said.
And the truth is, this stock was valued for 20 years on subscriber growth. And that's all people cared about. If you kind of remember, and I know you guys were in grade school, but the dot-com boom, all we cared about was the number of email accounts or the number of users. And that's true of Netflix from 1997 until effectively yesterday. And what the company is now doing is acknowledging that it's no longer a super high growth company, but it is remarkably profitable. And so, we have to transition to looking at them as a low growth company with lots and lots of profit. And I think that what investors are missing today is that the spend on content is likely going to be steady state. There's, if you're spending $17 billion a year on content at 270 million users, do you really need to spend 10% more at 300 million users? Like, no, they have plenty of content. So the leverage from even modest growth is going to be massive, and the cash flow number is going to get giant. So yes, I think it's worth $725. I think the sell-off is overdone, but people are disappointed because they've been trained to value these guys based on subscriber growth.
But Michael, it doesn't sound like you're that disappointed that you're not going to get those subscriber numbers anymore, because you're thinking that this company needs to be valued in a different way.
That's exactly right. And, Harvard Business School wrote a case about my valuation of Netflix. And I've been saying this for 10 years. It wasn't sustainable as a high growth, low profit company. It had to transition to a low growth, immensely profitable company. They started to do that in 2022, and that's when we upgraded, May of 22. And, I said it then, and I'm saying it now. They just had to complete the transition and acknowledge this is how we should look at them. We don't look at Facebook as a high growth user company. We look at it as a high growth profit company. We don't look at Google as, adding users. We don't care at all. We just care that they find better ways to monetize. Netflix has done that. They found better ways to monetize. The two big things are the ad tier, which not only grows revenue through higher, ad revenue per thousand per thousand views, but also allows them to bring in lower income customers, and also allows them to retain people who are churning out. And then the second is password crackdown, no sharing. That means I'm going to pay more when my kids move out. I'm going to buy my kids $7.99 subscriptions rather than make them pay themselves at $15.49. So these two things add a lot of revenue, and that's where we should really start looking at. I mean, we should start thinking about Netflix as growing revenue. Who cares how many users they have?
Let me ask you something, and forgive me because I'm going to go in a tangent, but Tim knows I kind of do this. Apple, do you feel the same way about Apple, that maybe it's a lower growth company, but it still sells a whole heck of a lot of stuff?
Yeah, I mean, I don't cover Apple. My colleague Dan Ives does, but yes, you sell 500 million or 900 million phones a year. Do you really care as long as all those people use every app and they're paying in the App Store? Like, you don't care at all. So, the App Store revenue was...
ECB's Mueller sees a few more rate cuts by the year end after June if the economy is in line with the ECB expectations.
So if you have 900 million phones out there, they have more, you can sell 900 million AirPods. Yeah. So people start thinking about the basket size. So yes, Amazon, same thing. Do we know how many users Amazon has? We don't care. I mean, I personally went from one item a month to 3 items a day delivered from Amazon. And we all are doing that. So we all get it. We understand that Amazon just starts to replace all physical retail, and we don't care if there are more users. Same with Apple. We don't care if there are more users as long as those people buy more.
I love what you're saying. It's interesting, but it's like a total rethink about how we value these companies, or certainly how we report on these companies. Do we get to that point? Is the analyst investment community going to go there at some point?
Well, they're there on every one of the, the big top tech companies, except for Netflix and probably for Tesla and probably for NVIDIA. Every other company, Microsoft, like nobody thinks Microsoft is growing users. They just think Microsoft is growing the way they monetize users. Nobody thinks Amazon is growing users, or Apple, or Google. So no, I think that every large tech company, every $250 billion company or bigger, we should start thinking about them as achieving steady state users, but figuring out how to grow basket size. And that's where Netflix is right now.
Okay, Michael, I want to talk about these different levers that Netflix has to use to increase revenue. I want to talk prices here. I mean, how much room does Netflix have, especially in markets where it's really fully penetrated, like the United States, to actually raise prices?
Well, I think that you're going to see streaming competition kind of drop by the wayside. Let's see what the new owners of Paramount choose to do. Sony's not going to be able to suffer through, big losses on Paramount Plus. And so I don't know yet. Disney is not going to take losses forever. They'll flail for a bit. But as Disney pulls ESPN onto a standalone streaming service, they're going to realize that's a huge mistake. Peacock is unsustainable. Truthfully, I'd say people will probably pay about $20 a month. The average user on Netflix consumes 65 hours a month of content. That's worth $20. I mean, that just doesn't turn out to be very expensive, 30 cents an hour. So I think 20 they can get to. I think on the ad tier, they could probably get to something like 6 ads per hour at $40 per thousand. And that means you're talking about $20 or so per month just in ad revenue. So I could see the average revenue going up. And this password sharing crackdown also is going to take that number above 20. So I think $20 per user is, at least in the US and Canada, is pretty realistic. Cut that in half probably for Europe, and then cut it in half again for rest of the world. So again, $20 here, $10 Europe, $5 rest of the world, but I think they're going to get there. I really do in terms of ad.
You obviously like it. You, as we mentioned, your 12-month price target of $7.25, 30% upside roughly from where we are. What are the problems? What are the risks, though, with the Netflix story? I mean, nothing's ever perfect, except, of course, my co-host. But other than
that, their arrogance is probably their biggest adversary. They don't seem to think that they need the analyst community. So probably half the people who cover the stock could not explain to you what I just explained. They don't have analyst days. They sent out something for the upfront meetings, and they told my team we can send one person. We said, can we send me and my co-analyst? And they said, nope, only one. They're jerks. They don't seem to have any interest in hearing external views about anything they're doing. So their game strategy is just idiotic. And again, a very large shareholder of Netflix told them they should talk to me about games. I was copied on the email introduction, and they never replied.
NYMEX gasoline May futures settle at $2.71 a gallon. NYMEX diesel May futures settle at $2.54 a gallon. NYMEX WTI crude May futures settle at $83.14 a barrel. That's up 41 cents or 0.5%. And NYMEX natural gas May futures settle at $1.75.
That's why, some people recommend that you should talk to those folks about games. I'm wondering if that changes just in the last 30 seconds that we have with you, Michael. Does that change at all now that increasingly you argue they're viewed as a value stock? Will they start to open up a little more?
I don't think so. I think your first point that they're becoming more opaque, this has been their formula for success. They have consistently lowered the number of data points that they provide to investors for the last 15 years. This is their DNA. So no, I don't think so.
All right. So appreciate your time today. Michael, have a great week. And Michael Pachter, Managing Director and Entertainment Analyst at Wedbush Securities, joining us from Long Beach, California. I'm looking at shares of Netflix. Tim, down about 9% here. So pretty much hovering near their lows of the session, down the most in about 2 years. So certainly one of the laggards we're seeing in the session.
Well, speaking of laggards, we're also seeing the NASDAQ composite move lower by 1.8%. 0.8% is how far we're seeing the S&P 500 move down, and the Dow up by 0.4%.
All right, everybody, all those private jets at New York City area airports that you're seeing waiting at midnight to take off, what's going on? Well, when it comes to taxes and the wealthy, every minute matters. That story's coming up next. First up, though, let's get a check on World and National News. Amy Morris, all yours.
All right, thank you, Carol. All 6 alternates have been selected. All 12 jurors are seated. The hush money criminal trial against Donald Trump could see opening arguments next week. The foreign aid and TikTok bills have cleared a procedural hurdle in the House. Lawmakers are working this weekend on the foreign aid package to Israel, Ukraine, and Taiwan, and that measure that would force TikTok to separate from its Chinese parent company, ByteDance. House Speaker Mike Johnson.
Even though it's not the perfect legislation, it's not the legislation that we would write if Republicans were in charge of both the House, the Senate, and the White House. This is the best possible product that we can get under these circumstances to take care of these really important obligations.
The plan largely mirrors the $95 billion foreign aid package that the Senate passed in February. Tensions escalating in the Middle East. U.S. officials say Israel launched a retaliatory strike on Iran. That's less than a week after Tehran's rocket and drone barrage. Secretary of State Antony Blinken at the G7 summit says the group of nations is urging de-escalation.
You'll see soon in the G7 statement a commitment to hold Iran to account for its destabilizing activities, holding it to account by degrading its missile and drone capabilities.
Iran says the attack was limited in scale and they're not inclined to launch a counterstrike. Global news 24 hours a day, whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years.
US stocks extend fall, NASDAQ down 2.02%.
As I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Fresh lows for the S&P 500 index.
And the S&P 500 now down 1%.
61, a drop right now of just about 50 points, a decline of 1%. Dow Industrials holding on to a gain of 110 points, up by about 0.3%, while the NASDAQ Composite Index is now lower by 331 points, down 2.1%. 10-year at 4.61% with a 2-year yielding 4.97%. Spot gold up 0.7% right now on the precious metal, higher by $16 the ounce. West Texas Intermediate crude oil up 0.5%, 83.14 for a barrel of WTI. A sell-off in the world's largest tech companies hitting stocks. Traders also shunning riskier assets ahead of the weekend amid geopolitical uncertainties. Speaking of tech names, Super Microcomputer had its biggest drop in about 2 months today after the maker of servers announced the date of its third quarter results, but did not pre-announce results. We've got Super Microcomputer down now by 21.7%. Recapping, the Dow higher, S&P, NASDAQ both lower. S&P at 49.60, a drop right now of 1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So, Tim, it's kind of hard making a lot of money. I mean, you need to log your days, prove where you are all the time, where your pets are, where your Peloton is. When exactly you are hopping on those private jets, it just isn't easy.
Well, all of this from one of our most read stories on the Bloomberg terminal. Bloomberg News, New York politics reporter Laura Namias joins us here in New York City. Laura, I love this story. You open with just an incredible anecdote about what happens with private jets coming to New York City, or leaving New York City, I should say, and also SUVs that are just over state lines. Share what exactly you found in your reporting.
Sure. Well, the genesis of this story came when my counterpart in California found that the state of California has actually
And Brent crude futures settle at $87.29 a barrel. That's up 18 cents or 0.21%.
In fact, leaving the state. They've also increased the amount of money that they found. And so we reached out to tax attorneys to find out a little bit more about the ways in which the wealthy residents of New York and California handled their taxes when they move. Moving out of the state and flagging that on your tax returns is basically a surefire way to get audited by the states, both of these states, especially if you're a really high income individual. And the rules are so strict that some of these wealthy individuals are they're very careful about not tripping up the thresholds that would require them to pay the taxes, the income taxes that a New York full-time resident would have to pay.
Laura, listen, we've done so many stories, you know this, and this is actually the most read story on the Bloomberg in the past 8 hours, so everybody's reading it. So kudos to you and your colleague for writing it and putting it out there. It's interesting, but what's interesting is we have also talked about people leaving New York, going to Florida, especially in the financial community because of the lower tax environment. Having said that, what constitutes making you a Florida resident officially versus a New York? You know, how many days do you have to be there, and what constitutes a full day in one state versus another? I mean, it's the devil's in the details, I'm assuming.
Yeah, it's true. So there's two ways that you can be a resident in New York, and this can surprise people sometimes. If you have a house here and you live here and it's your main residence, then you're a resident. That doesn't seem that surprising. But you're also considered a resident if you maintain something called a permanent place of abode in New York, and you are physically present in the state for 184 days. So after 183 days is the threshold. So that means that people who, especially incredibly wealthy people who maintain more than one home, if they maintain a home that is livable year-round in any part of New York State and are physically present in New York for 184 days or more, then they are liable for New York state income taxes.
So you have to pass the teddy bear test. You know what that is, Tim.
The teddy bear test. It's not just about teddy bears, Laura. Explain what exactly the teddy bear test is.
So when you get audited, this was so fascinating to hear from the tax attorneys. When you get audited, auditors are going to look into every aspect of your life. They're going to look at your bank records, your phone records. Sometimes tax records show that they've asked for full lists of your medical doctors. We saw one case in which a person, provided evidence that they were seeing their OBGYN on a day in Florida, on a day to prove that they were in Florida. But the teddy bear test is auditors are looking to see which residence you use to house items that are near and dear to you. So the stereotypical item is a teddy bear, something you love and treasure. But for various people in these tax cases, that near and dear teddy bear-esque item could be their Peloton. It could be a vintage sneaker collection. It could be any number of things that are incredibly special to them. And if they keep that in Florida, it's more suggestive that they actually live in Florida than in New York.
Well, I'm just going to say to you, Carol, if you are worried about, income taxes and you don't have a Peloton in every home, then come on, you got to have a Peloton in every home.
That's right. That's an easy fix. What about the family dog? Where does the family dog have to be?
Well, if you say, for example, that you live in Florida, but you keep your dog in New York and your dog's veterinary records show that the vet is in New York, then it is more suggestive to auditors who are really well-trained investigators that your dog that you consider residence than Florida.
Fascinating.
The reason we're talking about all this, Laura, is because it's a serious issue for New York State and increasingly becoming a serious issue in California, though there are differences between the states. These are to New York State's coffers, how much they've been able to recover in recent years, and what happens if these wealthy residents are successful in completely fleeing the state and not paying income taxes here.
Yeah, so both states are really reliant on their high earners for income tax revenue. New York in particular, somewhere around 45% of its income tax revenue is coming from the very top percent of earners in the state. And so what that means is that the state's revenue is really sensitive to the flight of even a handful of individuals. And this is something that we're using to help prop up our, for example, $237 billion state budget. And we're talking about money for schools, Medicaid money, fixed costs that seem to grow every year, and we're relying on the income tax revenue from a very small handful of people. So if they leave, it could be potentially problematic. This is something that state tax officials and state politicians have talked about for years. They've wondered whether tax policy really has an influential effect on whether or not the super rich people leave New York. And what it seems like, at least anecdotally, and they're still studying this, is that it hasn't had that much of an impact prior to the pandemic, but the pandemic, the ability to work remotely, maybe combined with a more favorable tax policy in another state, could be just the straw that breaks the proverbial camel's back and convinces you to maybe relocate somewhere else.
I thought it was interesting, too, you include in the story, although the total number of taxpayers leaving New York and California from 2020 to 2022 was highest among low and middle income people, as you just point out, the flight of the richest individuals has an especially large impact on budgets. And this is why we care. And this is why it's a really interesting story. Hey, last point, though, the cottage industry that is rising as a result, all these apps to kind of track where they are?
Yeah. So yes, tax attorneys told us that there's just a panoply of apps available now that not just for rich people, but for people who consider themselves digital nomads, young, upwardly mobile people who like to telework from Tahiti or, from Italy or something, and move around quite a lot. It's very hard to keep track and keep a paper trail of where you physically are. And these apps are doing capturing that data for you, so you don't have to proactively keep a record of your own days, and that becomes very helpful come tax time.
My dogs, my bed, my teddy bears, my Peloton, they're all in New Jersey.
And you're only traveling to New York. So
right. Little subway ride every morning.
It's not really helpful when it comes to your taxes, I'm sorry to say.
No. Just got to work on some other things. All right, listen, this is a great story. The most read story on the Bloomberg on this Friday. Laura Namias, thank you so much. So glad we could break it down with you. She's New York politics reporter at Bloomberg News, joining us right here in New York City.
Coming up straight ahead, stocks on track for their third straight weekly decline as the S&P 500 breaks below 5,000. More on the trade and the outlook in Options Insight.
At 3 p.m. Eastern Time, we expect comments from ECB's Nagel, who speaks at Peterson Institute in Washington, D.C.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Sources tell Bloomberg Morgan Stanley has hired Andy Lipsky, J.P. Morgan Chase's vice chair of investment banking. He is set to join the bank in coming months in a similar capacity, according to one of the sources who asked not to be identified. We've got shares of Morgan Stanley up today by 0.6%. J.P. Morgan Chase also higher today, advancing by 1.9%. Earnings news. American Express is reporting revenue that topped estimates in the first 3 months of the year as consumers continued to flock to the company's premium credit card offerings. The New York-based credit card giant said revenue jumped 11% to $15.8 billion in the first quarter. That beat the $15.77 billion average of analyst estimates compiled by Bloomberg. American Express shares on a down day for the S&P. They are advancing today by just about 5.3%. Netflix shares are tumbling as a weak forecast for revenue and a warning that the streaming giant will stop reporting subscriber numbers in 2025 overshadowed an otherwise strong start to the year. Netflix now down 9.5%. Expectations for Netflix's first quarter had soared in recent days as one analyst after another published rosy forecasts. But again, after earnings, Netflix now down by 9.4%. Tesla is recalling almost 3,900 Cybertruck pickups to rework or replace accelerator pedals that can dislodge and cause the vehicle to unintentionally accelerate, increasing the risk of a crash. According to a recall report submitted to the National Highway Traffic Safety Administration, the car maker is checking out what is happening to those Cybertruck pickups. Tesla shares down by 1.75%. Those are our top company stories.
At 3 p.m. Eastern Time, we expect comments from ECB's Nagel, who speaks at the Peterson Institute in Washington, D.C.
With Carol Masser and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody, we've talked about the S&P 500 breaking below that 5,000 mark. Let's get to options, insight, and more on the markets. With us is Bloomberg News Markets correspondent Abigail Doolittle and a voice well known to our world, University of Akron Endowment Chairman Dennis Gartman. Abigail, all yours.
Thanks so much, Carol. And Dennis, great for you to join us today. And, you know, I love to hand out congratulations where they're due. And I feel as though this is really true for you because when you joined us for Options Insight last November or December, you made the very bold call that you could see us having a bear market this year. You also said that that time period reminded you of this change between 2021 and 2022. Now, bearish divergences have gone on longer than anyone could think. But right now, I'm looking at this S&P 500 on the month down 5.6%, heading to its worst month since December of 2022. The Russell 2000 down nearly 10% in the month of April, heading to the worst month since September of 2022. How much worse do you see this getting? Do you think that bear market really will happen?
I think the bear market is just beginning. I think it's going to happen. I don't think there's any question about it. The fact that we're only down about 5 or 6% from the highs in the S&P, maybe 10 or 11% from the highs in the Russell 2000. I think it's just starting to get going, and I think the public is now becoming aware of the fact that prices have begun to weaken. So it's a little dismaying that the Fed is clearly not going to be cutting interest rates as much as people had thought. I thought it was almost comical 2 and 3 months ago that the expectation was that we'd have a 3 to 4 cuts in the overnight Fed funds rate, maybe even 5 to 6 at one time. I maintained that we'd be lucky to get 1 or 2. Now we're going to be lucky to get 1. That's weighing on prices. And I think the psychology is beginning to change. So, yes, I think the bear market is beginning. It's been long overdue, but I continue to be bearish on stocks and quite bullish on gold. I've been very fortunate in the past month and a half. Let's hope that that good fortune continues.
Absolutely. No one deserves it more than you, or at least you deserve it as much as anyone else does. And bringing in the Fed, that's really interesting because the Russell 2000 is almost down on its 200-day moving average, looking likely to slice below it. Probably the S&P 500 follows fourth, given the fact that those small cap stocks are a little bit more sensitive to the Fed. But gold and the Fed, talk to us about why we're seeing record highs here. Does that have to do with the Fed as well?
I think the market wants to understand that the buyers have been central banks around the world, predicated upon the fact that the United States seems to be a less strong ally and somebody capable, or a government capable of not just freezing assets from the Iranians and the Russians, but to actually take the assets from the Russians particularly. That, I think, is causing some concern. That's a reason for the Chinese to be a strong a strong and consistent buyer of gold. The Russians have been strong and consistent buyers of gold. The only thing that bothers me about gold is that the public is now beginning to buy gold. That's always they're always late to the party, but I think that they still have some time to enjoy a movement that has been extant now for several years. And what's important is this is more than just a dollar-denominated gold move. This is a euro-denominated gold move and a yen-denominated gold move. So it's gold going up in all currencies across the board, and I think that we need to pay attention to that fact.
So geopolitics weighing on stocks in part, helping out gold, and that VIX, well, it's at a 19 handle. I'm guessing if you're bearish on stocks, Dennis, you're bullish VIX. Thanks so much for joining us for Options Insight.
Shortly expecting comments from ECB's Nagel.
And the chair of University of Akron Endowment. Carol, back to you.
All right, so appreciate it. Our Bloomberg News Chief Markets Correspondent, Abigail Doolittle, there with Options Insight. All right, folks, getting ready to wrap up on this hour of Bloomberg Business Week. If you're watching on television, the close is coming up next. For those of you staying with us, we're going to check in with the Dean of the NCI Business School. We're also going to talk about the Bitcoin halving, and what else do we have?
How about trading a career in a London office to go to France and make rosé?
Sign me up.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Netflix disappoints, chip stocks slide in the S&P, breaking below 5,000. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. Israel's strikes on Iran deepen the uncertainty hanging over what comes next in the Middle East, particularly ahead of a weekend. And that has kept the momentum in U.S. stocks to the downside. The S&P 500 right around session lows, below that 5,000 level that Romaine just mentioned, off by 1% right now. The Magnificent Seven, the big tech space, certainly leading the declines. Netflix, one of the big names, of course, on the decline, even though it's not a member of the Mag 7. We are seeing a little bit of a safe haven bid for treasuries or short covering or a bit of both. The 10-year yield comes down 2 basis points to 4.61%. And oil prices did spike earlier. The proxy, of course, for geopolitical tensions, rising as much as 4.3%, but has eased off a little bit now, currently up by 0.9%. WTI 83 and change. Romaine?
Yeah, let's take a closer look at that geopolitical trade, particularly that overnight flight to safety that we saw unwinding a bit here as the impact of that strike on Iran appears to be minimal. While oil, the dollar, and Treasury prices have all reversed those overnight spikes, keep an eye, though, on those folks who are going to be seeking portfolio protection heading into the weekend. At least one of the major options trades this Friday made a big bet on Brent crude reaching $150 a barrel by August. Treasury flows, they show an $8 billion bearish bet made yesterday that would protect against a spike in the 10-year yield above 4.7% by June. And while spot gold has pared its gain, it's still closing out the day with the 5th straight weekly gain and a record high. As for equity markets, the S&P 500 is set to do something it hasn't done in 2.5 years. That's fall for 6 consecutive days. Interest rate uncertainty, along with some disappointing earnings, has pushed the S&P now about 2% below its 50-day moving average and leaving it perched only about 1% above that 100-day. More than half of the NASDAQ 100 stocks are at their 4-week lows, with that index now having erased more than 3/4 of the gains it had to start the year. So no surprise that we've been seeing equity exposure among investors dropping by about half for active mutual funds over the past 3 weeks, with prime brokers also net sellers over that same stretch, and hedge funds selling over the past 2 weeks as well. Now, those are the institutional flows, though, Scarlett. When you take a look at some of the retail flows, a slightly different picture.
Absolutely. When you look at certain ETF flows, retail investors don't seem to be participating in this pullback. You look at VU, which is Vanguard's low-cost ETF tracking the S&P 500. It has seen positive inflows every day this month. That's even as the index itself is down about 5% in April. So by this measure, retail investors are buying the dip. Now, positive net inflows is kind of the norm for VU over the past 6 months. If anything, the few times where you see meaningful outflows, let's say in last December and of course in March as well, the S&P 500 was still moving higher. So, Romain, maybe retail investors are the real smart money.
Yeah, we're certainly going to find out. I think there's a lot of people really questioning now what is driving this market. We had a chance to catch up with Sinead Colton-Grant, the CIO over at BNY Mellon's wealth management arm. She told Bloomberg that Fed cuts don't actually matter that much anymore and that it's earnings that are really key right now in order for stocks to rise, saying that equity markets can do very well with inflation in the 2 to 4% region, which is where they are right now. The problem has come when we've been north of 5% and heading toward double digits like we were in 2022. But she says that they think that right now it's actually a pretty constructive environment for stocks. That was Sinead Colton-Grant talking to Bloomberg News. Dennis DeBuscher joining us right now on Bloomberg TV. He is the president and chief market strategist at 22V Research. And Dennis, I do wonder if this is much more now a story about corporate fundamentals rather than the obsession that we've had for the past couple of years over what the Fed is going to do next.
Well, I do think corporate fundamentals are an underlying support for the market, but there is a particular problem as it relates to financial conditions right now that are impacting the market. We ultimately think it will be a short-term headwind in nature, but the fact of the matter is we started this year with economic growth outlooks from a consensus point of view about 1.3%. There was a very large consensus that thought there was going to be 6 cuts, which meant that inflation was going to be benign. And lo and behold, we ended up with much stronger economic growth than people were expecting. Atlanta Fed's GDP now casts at 2.9%, and inflation that's clearly sticky to the high side. So we're in a situation that was similar to 3Q last year, where financial conditions are tightening now, led by the U.S. Treasury yields, as you've seen, that will probably go to a point that make investors comfortable that there's less upside inflation and economic risk. And we don't have to worry about the Fed potentially even raising rates. And until we get through that process, again, a lot like we did in 3Q last year, until we get through that process, the market's probably going to struggle. So earnings, yes, they're a support. Don't get me wrong. But we do have this little FCI tightening that's happening right now, which is complicating. And the way out of it is just lower inflation over time and investors getting comfortable with that outlook. They were very comfortable to start the year, less so now.
Do you have, I guess, any confidence, or are you seeing that confidence in the folks that you survey that we are going to maybe see that relief soon, meaning like maybe within the next 6 to 8 months?
Yeah, that's, I think, the issue is I think there was too much confidence in that. So there is a significant amount of confidence that you'll see some deceleration in inflation over time. I'd say it's 60-40, so that's a little bit harsh for me to say it's too much confidence. But yeah, I think most people are still set up for the idea that over the next year, you should see inflation on a core basis decline in a way that would be friendly for asset prices, meaning the Fed can continue or will, reduce rates in a way that they somehow get back to neutral. And any data point that questions that is an issue for the market. And most now being felt most definitely in, say, price momentum factor, which is coming under pressure today, which is NVIDIA, Netflix, and the stuff that you already noted.
I know you don't talk about individual stocks. You mentioned earnings are a source of support, Dennis, except some of the high flyers are, giving less information about earnings. You look at Netflix yesterday saying that it's no longer going to give subscription numbers the way that it used to, following in Meta's footsteps. And we've seen how Apple in the past has stopped reporting sales of units of iPhones or iPads or Macs. What kind of statement does this send to investors in terms of the information that companies are willing to impart to the market?
Well, I'll use a little sell-side trick here. I think ultimately earnings are a support for the market over the course of this year. The problem with earnings season now is earnings expectations came in or inflected higher into earnings season. So the bar was high. Basically, since the Fed tightening program started, earnings expectations had collapsed into earnings seasons. And this was the first one we've seen basically in 2 years where you had this big lift. So it's not that earnings are necessarily poor. It's just that the expectations were very high going into this quarter. So in aggregate, earnings are strong. They're improving. You'll probably end up at 243 to 245 this year, which is great. I mean, that should support the market over time. Just that expectations were a little bit elevated in an environment where you have an inflation concern.
Right. I hear what you're saying about how expectations perhaps are a little bit stretched going into this earnings season, but the fact that companies are giving less information to investors who are desperate for evidence that their valuations are justified.
Yeah, it's a good point. I think leaning on company commentary about the future, certainly the macro backdrop is one of the worst things investors can do. Because when we've looked at this using a natural language processing tool, what they say about their own business is actually very positive and has consistently been positive. What they say about the outside world and the macro backdrop and inflation backdrop and uncertainty and every analyst on the street beating them up about the world is going to end, you've ended up with company commentary that has consistently been subdued. So I think it's just a little bit more being felt now because expectations were lifted going into the quarter. But I would fade this idea of like uncertainty and that being a signal because that has been really consistent. And
ECB's
wrong,
Wunsch says
for the last 2 years.
ECB decisions will get harder after 2 rate cuts, and slower Fed cuts are likely to feed European inflation. The July meeting will give signal on the rate path, and an oil spike would impact the timing of rate reductions.
And a lot of other cash that certainly isn't being deployed to risk assets, if at all.
Yeah, I mean, I take a little, I understand that view. I just take a little bit of a more, and when you think about it this way, if money sitting in those assets is because interest rates are higher, because the nominal growth backdrop is better, right, and equilibrium interest rates have shifted higher, then your earnings growth over time should be significantly stronger. And if your earnings growth is significantly stronger than the cost of capital, which is the case right now for most of the S&P, then the market will be biased over time. Money will find its way into the market. So I fade the idea that there's like this lower return profile in equities relative to what you could get in cash. The reason cash rates are high is because demand growth and inflation as a result is a little bit higher than normal. So you're just kind of shifting up now with interest rates to just help keep inflation and demand growth in check. But ultimately, you're looking at a pretty good nominal growth / nominal earnings backdrop. Enough to offset whatever you're going to be getting in a cash account.
All right, Dennis, going to have to leave it there. Always great to talk to you. Have a wonderful weekend. Dennis DeBuscher, President and Chief Market Strategist at 22V Research, helping us kick you off to the close here on this, Taylor Swift Day, because right now millions are streaming the highly anticipated Tortured Poets Department album. But because we're Bloomberg, we always like to take a closer look at the economic impact of Miss Taylor Swift. A conversation coming up in just a bit. And a big question for you, Scarlett. Is Taylor Swift underpaid?
Oh, definitely. For sure, given her impact. All right, lights, camera, and deal action. Paramount shares are on the move as Apollo and Sony said to be teaming up on a joint bid. We'll have more in today's top calls.
And a check on the e-luxury marketplace. Quite a few of those e-luxury retailers are struggling or gone under. My Teresa, though, hanging in there, posting earnings. A conversation with the CEO a little bit later in the program. You don't want to miss that. A lot more coming up right here on The Close. This is Bloomberg.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Swifties all over the world gushing about Taylor Swift's latest album. The Tortured Poets Department dropped at midnight Eastern, and just 2 hours later, she announced a surprise album with additional songs. Amazon Music says it is already the most streamed album in its first day on the platform. And of course, her fans continue to drive her fame and economic success to unprecedented heights, even making its way into the classroom, leading some colleges to incorporate Swiftonomics into their curriculum. For more, we're joined by Ryan Herzog, Associate Professor of Economics, who is doing just that at Gonzaga University. Ryan, it's good to speak with you. On this day of the launch of the Tortured Poets Department, tell me a little bit about Swiftonomics and the launch of that album and what it means for the music industry at large if you were to incorporate Swiftonomics into your curriculum today.
Yeah, I mean, I think Swiftonomics is really just taking everything Taylor has done and creating a Principles of Economics Taylor's edition, basically. From everything she's done in terms of releasing her tour, ticket pricing, all of those dynamics have certainly contributed to our ability to incorporate her story into our classes and get students more engaged. This album is just another example of her kind of utilizing economic principles to her success.
So one of the economic principles you mentioned she's utilizing is diminishing marginal utility. She's in the middle of her Eras tour in Europe. She's still releasing an album. Explain how that works.
Yeah, I mean, with students, I talk about, for me, Easter just passed. I love those Cadbury cream eggs. You have the first one, you get a huge satisfaction out of it. By the time you've had 4 or 5 of them, you're probably getting a little bit of a stomach ache, right? With Taylor, she's been played a ton of times on the radio. Tons of people have listened to her. Her songs are starting to lose some airplay. Right? The value you get from listening to one of her hits, Anti-Hero Cruise Summer, is probably dying a little bit. So it's time for a new release. She's still on social media. She's still getting a ton of attention. So the demand for her is there. It's now another opportunity for her to get back on the airways with new music.
And of course, at some point, Ryan, she's going to actually be back on tour. Talk to us about the potential economic impact. There was a lot of hay made when we had those big tours last summer with her and Beyonce. I've seen some statistics saying that for every $100 spent on an actual concert itself here can translate to something like $200 to $300 extra spent on hotels and other things like that. How do you quantify it?
Yeah, I mean, I think every visitor to a city seeing Taylor Swift is going to add $300-400 a night in hotel, food, merchandise, everything else. So it's a huge tourism boom. If you look at her going back on tour this summer with her heading out to Europe, we're seeing entire industries formed around Taylor Swift travel. You look at ticket prices in North America, the cheapest venue is going to be $2,000 to see her in Miami. You can go out and see her in Spain for $500-600. So Americans are packing up. They're traveling over the Atlantic. They're planning family vacations in Europe to see her shows.
Is there anyone else that has that type of impact? I mean, usually when we talk about the economic impact of something coming to town, it's usually something like, the Super Bowl, the Olympics, something that's more than just one person, if you will, here. I mean, who else has that kind of clout and power?
I mean, it's the Super Bowl every weekend, basically, in a new city. She's driving so many people to these venues, so many people to the concerts. We've racked our brain trying to figure out who. My co-author, Paul Krugman, he does a lot on Jenny Lind and her success. For those that remember P.T. Barnum, lately the Beatles, when they made it to America, maybe Michael Jackson throughout Europe on his tours, but there's very few people. I mean, Beyonce this last summer obviously made a splash throughout Europe as well, but not many people are generating the revenue that she is generating.
Yeah. All right, Ryan. Well, this is great stuff. And as you know, I think a lot of people not just fascinated by Taylor Swift, but really the economic angle as well. And I really appreciate what you and Professor Krugman have done to just kind of make economics a little bit more accessible to a lot of folks out there. Ryan Herzog, Associate Professor of Economics over at Gonzaga University. So, Scarlett, the question is, have you listened to this album?
I've not listened to it yet.
I haven't listened
I'm a late adopter to all of this, though. I'm going to wait for it to show up in some streaming show, and then I'll get into it. Do you think she consults an economist before she makes decisions?
No, I don't think so.
Or she just instinctively knows how to do this?
I mean, maybe. I don't know. I feel like at this point, she's not really a person anymore. She's basically a corporation.
Taylor Swift Inc., yeah.
So I guess at some point, you know, she probably has a lot of folks around her who give her more economic and legal advice as to...
I'm sure there's some trained economists on her staff. I'm almost certain of it.
Okay, maybe. How much do they get paid? All right, coming up here, we're going to talk about Paramount, actually one of the big movers here on the day, as we're learning that, well, a bidding war might actually be ramping up. Sony Pictures and Apollo looking to join forces for an offer for that company, which is on the block. That's coming up next, right here on The Close on Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start things off with DoorDash. Loop Capital starting coverage of the food delivery company, a buy recommendation and a price target of $170. The analyst seeing post-pandemic momentum for DoorDash leading to greater long-term growth. And while the stock is trading at a premium, the analyst says it's actually justified based on the company's execution and earnings power. The shares nevertheless getting caught up in today's downdraft, down 3%. Next up, Ulta Beauty cut to hold from buy over at Jefferies. The price target slashed 25%, down to $438 from $585. Competition from Sephora and its addition of trendier and emerging brands is where most of the pressure is coming from, according to the analyst, saying that for Ulta, it's still heavily reliant on those legacy brands, many of which are now available in off-price retailers like TJX, and that makes the analysts way more cautious on Ulta's ability to sustain double-digit same-store sales growth, shares down by 2.5%. Finally, let's take a look at Netflix. A slew of changes today. Canaccord Genuity hitting the back button on its recommendation, a downgrade to hold, while the analyst Marla Ripps actually acknowledges a solid first quarter results. She says it wasn't enough to convince her that Netflix has more on the way. She tells investors, look elsewhere for upside, and warns of slower growth ahead. Netflix shares having an awful day, down about 9%. And those are some of our top calls. Now, we do want to stay in the media space and, well, take a look at a stock that's actually on the upside today. Paramount Global, one of the big movers. This after Bloomberg is reporting, based on sources familiar with the situation, that Apollo has teamed up with Sony to consider a joint offer for the conglomerate. Joining us now to talk a little bit more about the prospects of that deal, as well as some of the other offers on the table, is Tim Nolan, Senior Media Tech Analyst over at Macquarie. He still has an underperform rating on Paramount. All right, Tim, we know that the Redstone family seems serious about going through with these deals. I guess the big question is, who is actually going to win it? The Skydance deals didn't seem to impress investors. What do we know about this Sony-Apollo mashup, and is that going to be something that's going to be more palatable for those investors?
Right. Well, we don't know a lot of the details about the potential Sony and Apollo alignment. Of course, Apollo, as far as we understand, made a verbal offer for a fairly significant premium to Paramount, which was rejected because Paramount is in exclusive negotiations with Skydance on a deal that investors are not happy with because it provides, a $2 billion payout to the National Amusements Holding Company for Paramount, and then would involve a stock merger between Paramount and Skydance, which I don't think investors are convinced would be a solution to Paramount's problems, nor would it provide, financial upside to them, certainly not in the near term, compared with an all-cash offer from Apollo, apparently for $26 billion enterprise value. What's new and different now is it brings in Sony, which I think is, regarded, certainly respected as one of the larger, more successful studios in the business. And so that just adds a whole new degree of heft, I think, to that arrangement. We don't know about any other financial considerations, and there certainly are questions as to what the new company would look like, what the management structure and so forth would be. But I think investors should take a Sony Apollo actual offer with a lot more enthusiasm than they would the existing Skydance arrangement.
Certainly. There might be some regulatory and antitrust issues that might have to be addressed in that, but certainly a lot more palatable. Any chance, though, Tim, that this is actually going to be, or we're going to hear something definitive from the company anytime soon? Earnings are only about a week away here, and people really want to know how much progress they made.
Right. And they're reporting earnings a little bit normally than they normally would. I think it's right at the end of April instead of into May. I don't know if there's anything behind that or not. But look, I don't know. I don't know what the exact ending date of the exclusive arrangement for negotiations is between Paramount and Skydance. I think part of the situation there is the interest of the chair of National Amusements, Sherry Redstone, to maintain some sort of control and to keep the company together. And maybe that's what Skydance offers. Versus Apollo and Sony, which might involve some sort of asset divestitures, some sort of shakeup of the ownership structure.
Right.
I don't know what the split of ownership would be. So there are a lot of questions around both deals, really.
Sure. Tim, you mentioned that shareholders not thrilled with the exclusive conversations between Paramount and Skydance because it doesn't give them very much. What recourse do they have? Or they just kind of have to wait out these exclusive conversations?
I guess they have to wait it out because Sherry Redstone has, I believe it's 77% voting control over National Amusements, which owns Paramount. So I suppose it's her call. But if you've got a number of large shareholders that are making noise saying they don't like that deal, you would hope as a common shareholder that would weigh in and influence how the Paramount board perceives this.
All right, so you're counting on them to do the right thing then, I guess. Tim Nolan over at Macquarie, thank you so much for joining us. Tim Nolan, of course, covering the media companies, including Paramount, which reportedly seeing a bid or potentially a bid from Sony and Apollo. And I don't know about you, but do you use the Paramount streaming service? I mean, have you experienced it?
Yeah, we had it for a while, and then I think once we realized we had like 15 streaming services, decided to jettison one, and that unfortunately was one of them.
Yeah, well, the lesser ones, I'm saying anything that's really not Netflix at this point, the user interface is just not great. The software is not,
Yeah, absolutely.
It's kind of glitchy.
Yeah.
That's what it comes down to. All right, coming up, we've got Regional Bank Huntington Bank shares posting a beat on earnings. Our conversation with the CEO coming up next. This is The Close on Bloomberg.
always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested, they want to be an early adopter of the stock, they're interested in the story.
or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup.
This is a three as the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
Bank of Canada's Macklem says overall we see downside risk to the inflation outlook are lower than they were. Canadian inflation is continuing to become less broad-based. Things are moving in the right direction. Reiterates that the bank will be looking for evidence that the recent downward momentum in inflation is sustained. The budget contains spending measures and new taxes. Federal government's commitment to stick to fiscal guardrails is helpful.
It looks like we're going to end the week on a down note. I believe 6 straight days of losses here for the S&P 500.
And Macklem says at first glance, federal budget does not really change the fiscal track since the November 2023 fall economic statement. And geopolitical tensions are a source of deep concern in the international community. There are some signs of stress in household finance, mostly in non-mortgage holders. Delinquencies have moved up, but they are not at alarming levels. If there is a spike in oil prices, that is something we'll have to take into account.
CEO Steve Steinauer a little bit earlier on, and he shared his view on the state of the regional banking sector and the potential for M&A.
We are very focused on growing the core. We don't expect any M&A this year. Well, in my 15 years as CEO, we've done 2 larger combinations, so that gives you some sense of this. We believe, having invested significantly last year, positioning us in the Carolinas. Earlier this year, we made a move in Texas. We added 3 specialty banking groups late last year, early this year. We're in really good shape. The core is performing well, and these new units, as they come on, will be an uplift, and that will be a differentiated position because most of our peers have been either reducing assets, reducing loans, or very modestly growing expenses, in some cases lowering expenses. So we have a differentiated position to play from. We're going to do that and build revenue.
Are you taking business from some of those competitors? Is that what you're implying, Steve?
We are. As you suggested, some banks have pulled back, larger banks in particular, not looking at the small, medium-sized businesses. And that's our bread and butter. We're the #1 SBA lender. We have been for 5 years in the country. We're not countrywide in terms of our lending activities. So we do a lot of business where we're located. And we've done this for years and years, have built a track record and a brand, and that is serving us well and will continue to do so. We have the strength to support our customers at a time like this, and we intend to do so.
What keeps you up at night? What worries you as we go through the rest of 2024? Does it have to do with regulations and increased capital levels? Does it have to do with the election?
The proposed new regulations are not going to be that significant to us. So the additional debt, if required, if it goes through as proposed, is maybe a couple $2 billion of additional borrowing for us, which is not a big number. That's essentially we go to the market one day and we have that. Our capital we continue to build and accrete, and we're already operating as if the Basel III proposal was enacted. So that. It's not going to be a game change for us either. So what we're mostly concerned about is what's going on geopolitically and globally, and is something significant going to disrupt the U.S. economy? Because if it does, we'll all feel that. But otherwise, the economy is doing fine. The Fed has reduced inflation by roughly, 50% or more, and it's just this last mile that's going to take a little time. But we've been around. For 160 years, we'll be around taking care of customers as we go forward in any environment.
And that was Steve Steinhauer, the CEO over at Huntington Bancshares. And I thought it was interesting towards the end here. He talked about a so-called Basel III endgame, which I think has been kind of unfolding now for like 75 years.
Yeah.
But he kind of basically said, look, we've already made our adjustments. We're ready for it. When it comes, they're just going to roll with the punches.
And that is surprising given the pushback from the banking industry itself, as well as a lot of the proxies that they've lined up to really make the case to lawmakers that this is going to be super costly. It's going to get in the way of a lot of things. For him, it's kind of like, it's a done deal. We're fine with it. We can move forward.
Yeah, it was an interesting conference yesterday with the SIFMA on Thursday, where they actually talked about this issue, and a lot of the participants there really had a chance to weigh in on that conversation. And we want to continue that conversation right now on some of the divisiveness around the Basel III endgame. Ken Benson is the president and CEO of SIFMA. He formerly served in the House of Representatives and has had quite a few opinions here about what's going on with the Basel III endgame. I am curious, Ken. I was going through some of the transcripts from what you guys talked about yesterday, and no surprise here, a lot of folks still concerned. But I wonder if you could kind of square that circle, because you have some folks on the kind of fringes of finance right now that are still fighting to block some of these rules. But then you hear from folks like Steinhauer over at Huntington, who I guess is just kind of resigned to it. It's like, this is going to happen. We need to prepare for it here. Is there some sort of middle ground here that we should prepare for? Are there going to be changes?
Well, I think if we take, first of all, thank you for having me on. I think if we take Chair Powell at his word, and I do, that there are going to be substantive and material changes to the rule. Rule proposal, I think that's a good thing, and even possibly a reproposal, which Chairman Powell didn't rule out. And you saw, if you saw our panel yesterday, our conference yesterday, Governor Bowman from the Fed said there should be a reproposal. We think there should be a reproposal. And I think the difference, and Huntington's a fabulous institution, by the way. I think the difference is what type of business is your bank in, and the larger dealer banks are really negatively affected by this. So while I think most large banks, if not all large banks in the U.S., including from Huntington on up, certainly have very high capital levels well before the Basel III proposal was put out. It's the structure of their business. So if you, and what we're particularly concerned about is the impact on the capital markets business. And if you look at particularly the U.S. G-SIBs, they are dominant players in the U.S. capital markets business along with the foreign G-SIBs. And that's going to be very negatively impacted by the proposal, with capital charges going up as much as 130% on traditional products like securitization or securities financing transactions. So that's really where people need to focus.
And I think a lot of people are focusing on that, Ken. Just to play devil's advocate, though, I think some of the folks who backed this proposal, which was formally unveiled last year, look at it and say, look, this is about making the financial industry safer, preventing bank failures, or at least sort of, trying to sort of stem the potential for those failures here. As this proposal stands right now, does that not do that?
Well, I'd start with the premise that we made the system more stable to where we are today. This Basel III endgame proposal has been 10 years in the making, but over that time we've seen bank capital grow exponentially in the U.S. And so I think in terms of aggregate capital, we've really hit the target of where we should be. The problem with this proposal is not just the total capital it raises on the overall bank, but again, what it does in the capital market side, and then how it interacts with existing prudential requirements and liquidity requirements, such as things like the stress test and something known as the global market shock. And when you put those together with this proposal, you really do impede capital markets activities of the large dealer banks. And the problem with that, as you know, is we fund 75% of commercial activity in the U.S. through the capital markets. That's a good thing. But that's going to have a transmission effect if you raise capital costs by the level that's being talked about, the way this rule plays out. So that's why it definitely needs, frankly, in our view, a reproposal. The Fed and the prudential regulators are only now doing a quantitative impact study, which they should have done before this proposal. They need to put that out for comment. We believe they will. And they really, if they are going to make material changes, they really need to put the whole proposal out for additional comment.
So this is 10 years in the making. The Fed has already made clear that there will be changes. You're talking about a reproposal. Is the goal here to just not propose anything, to kind of keep what we have?
I think the goal here is to get it right. And if you think about it in terms of how Basel III came, the iterations of it, the Basel Committee itself went through a reproposal because they put out an initial proposal. They did a quantitative impact study. They realized that they needed to do another. Then they went and reproposed and rewrote the proposal. It was supposed to be a capital neutral proposal and really trying to equalize capital across jurisdictions around the globe. But what the Fed and the other agencies have come out with doesn't do that. So a reproposal is a process of getting it right. It's not unprecedented at all. And frankly, I think if the agencies had done their quantitative impact study on their proposals before they set this out, they would have been in a better place. But again, it's about getting it right, not getting it done fast.
All right, Ken. Always appreciate getting your insights on this type of stuff. Ken Benson, their former representative in the House. We should also point a former working in the finance industry over at Drexel and now representing that industry as president and CEO of SIFMA. All right, coming up after the break, investors are reacting amid geopolitical concerns in Europe and in the Middle East. We're going to have more on that when we come back. Stick with us. This is The Close on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
All right, I want to turn to the world of U.S. politics right now. House Speaker Mike Johnson trying to push through a mega bill right now with support from his rivals in the Democrat Party. Joe Matthew joining us right now. He is the co-host of Balance of Power. And Joe, I was taking a look at this bill. This is ostensibly a bill to help fund Ukraine's efforts to fend off Russia, but it also includes funding for Israel, funding for Taiwan, a TikTok ban, and I'm sure I'm forgetting about 20 other things here. But the most intriguing thing about it is the only reason this is advanced right now, because a lot of Democrats are on board with this. What's happening?
That's absolutely correct. And to be clear, we're technically talking about 4 different bills, Romaine. The Speaker decided to cut them up into separate spending bills for Ukraine, another for Israel, another for Taiwan, and then this sidecar, they're calling it, which is kind of a cocktail of a few things. It's got the TikTok divestiture ban you mentioned. It's also got the Repo Act, which would pull money from frozen or seized Russian assets. And then you've got Iran sanctions in there. The problem is Democrats and Republicans are going to vote differently on all of these, so they couldn't likely have passed the House, according to the Speaker, on their own. He's trying to do this in a way where everyone has cover, and then after they're passed, they're all stitched together into one big Frankenstein bill that is then sent to the Senate, and they're expected to pass that bill. The president says that he will sign it. But, Romaine, it's interesting. You mentioned TikTok. That was already, it passed the House. It was sitting in the Senate, and it was going nowhere. Now senators are going to have a choice to make. If they're wary about this divestiture ban TikTok bill, they're going to have to also factor in Ukraine and Israel, and they don't want to vote no on that. So it looks like this TikTok thing is actually going to happen.
The old switcheroo there.
All right, Joe Matthew, thank you so much. Complicated day in Washington, but they all tend to be complicated when they decide to be productive in the end, right? Joe Matthew in Washington, co-host of Bloomberg Balance of Power. And of course, we're keeping an eye on stocks right now because we have declines in equities overall. But if you look at NVIDIA, Romaine, session lows for the big chip maker. And yes, this is a big, big decline, and it's been pretty weak. But for the year, it's still up about 53% on all those AI expectations.
Right. Well, this is a big AI sell-off right now. We should point out that the Philadelphia Semiconductor Index did enter into a technical correction 2 days ago here. And it's not just NVIDIA. NVIDIA is down 10%. Super Micro, not so super. That's down 23% right now. You pick a chip stock or an AI stock right now, they're probably down a double-digit percentage.
A bit of a regime change, it feels like, with the S&P 500 down for a 6th straight day, and we have another weekly loss here. I believe it's the 4th straight weekly loss for the S&P and the NASDAQ.
Yeah, absolutely here. And this, of course, was the big leadership for this market going forward. We are counting you down to the close with just about 14 minutes to go. Dana Dioria going to be joining us in just a minute, Co-Chief Investment Officer over at InvestNet. This is the close on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So looking now to the market on close, imbalance, 1.5 billion to the sell side.
It's going to end pretty much with a whimper.
Absolutely. Another day, another decline. This is 6 straight days of losses for the S&P 500. It's now below 5,000. And of course, the big reason why is because technology shares, whether it's the Magnificent Seven, whether it's Netflix, they're all tumbling right now ahead of big earnings for some of those big companies. Do we pin it on TSMC and its outlook earlier this week, or do we pin it on Netflix saying it's no longer going to give subscription numbers?
I think a little bit of both. Of course, Taiwan Semi really trying to temper some of the outlook for buy investors. We heard something similar from ASML, seeing the slowdown in orders and some of those high valuations that we've seen on names like Supermicro, Nvidia, and others, now causing investors to maybe take some chips off the table. Nvidia shares right now down 10% as we march to the close. Tom Giles, Bloomberg Senior Executive Editor for Technology, joining us right now. And Tom, it's not just Nvidia. Basically, you look at anything that had been linked to AI here, and they all seem to be under pressure. What's happening?
There have been so many pent-up expectations for these stocks. There's a lot of bullishness for AI. Anything associated with AI, even if you just mention it on a call, it resulted in a rally in your stock in the last several months. The stocks have just been going through the roof. So I think what happens now is, in light of ASML and Taiwan Semi, TSMC earlier this week, people are bringing a little bit more scrutiny to the AI story. Is it as good? Is it as lasting as everyone thought it would be, as we expected it to be? It's not this miracle drug, after all, and that's what people are wondering. That what they're going to look at next week, they're going to scrutinize every number that these Magnificent Seven release, and every comment out of their CEOs and their CFOs to figure out, is this real? Is AI as good, as real, as lasting as we had been expecting? And I think there's going to be a lot of skepticism.
And of course, I'm sure a lot of these CEOs or their communications team are kind of going over their planned remarks and revisiting what they can say to reassure investors. What will you and your team be listening for to determine whether this AI story is more hype or more substance?
Are the products changing? Are you using AI in a tangible way to change your product? Is it changing for the end user, whether that's the consumer, whether that's a business? Are people really buying your AI story, or is this just some magic fairy dust you're trying to sprinkle on your results? That's the question that everybody is going to be asking into next week.
All right, Tom Giles, who helps lead our technology coverage here at Bloomberg. We do want to keep the conversation going as we march towards those closing bells. Less than 7 minutes to go. Dana Dioria joining us right now, Co-Chief Investment Officer over at InvestNet. And Dana, I do want to ask about valuations here, because to Tom's point, at least when it comes to some of these tech stocks, the AI stocks and those chip stocks, you were looking at multiples that were way above any sort of historical realism. Now, some of that was on the hype, or I guess maybe the promise, that AI really was going to generate some returns down the road, but maybe that might have been priced in a little bit too far, too fast. What say you?
Yeah, I definitely agree. I agree with Tom's comments. I think it's not that the promise of AI is not there, it's not intact. It's just that, the market it's a leading indicator in so many ways, right? And when you think about, just what AI can do for corporations from a productivity perspective, the makers of AI are going to benefit a lot faster than the users of AI, I think, right? Most of the companies you talk to, a lot of economists agree on this, right? They're figuring out AI. It's early days for most companies to be exploring how they can use AI to become more efficient. And over time, it will be good, right? It should be deflationary. It should increase productivity, but we're just not there yet. And the market bump in these stocks is kind of probably premature in a lot of ways.
I am curious, though, how you even sort of model this, because I remember when the AI hype started bubbling up and you started to see these bids come in to some of these names. The question was like, how exactly are you modeling? How do you come up with a number where you say this is what the value is when no one even seems to know what the final use case was going to be for a lot of these products? And I know we've been here before where we've had sort of these market stories really overtake any sort of common
At
sense
4
on
p.m. Eastern
fundamentals.
Time, we get the Fed Financial Stability Report.
It was a lot different this time around.
I agree with you. I think think about a discounted cash flow model, right? And so if you're a maker of AI, if you're an NVIDIA of the world, maybe you're looking at what the demand for this is, and you can create some sort of revenue forecast based on that. I think, modeling from the perspective of the companies that are buyers, again, I don't think the models are there yet to even try to incorporate this. And I think, the valuation, Tom spoke about valuations, absolutely, and I just was looking at a chart actually from a great economist who was showing, S&P 500 information technology 28.5 times multiples, right? So when we look at the S&P 500 and the multiples that it's trading at, a lot of that is driven by these big growth stocks and information technology in particular. So it does, it's been skewing, it still continues to skew, and you're absolutely right. Actually going back to just fundamental analysis and how you're rationalizing those numbers is difficult.
Yeah, when we look at the big moves today, you have NVIDIA down 10%, $761, Supermicro losing 22% at the moment. Netflix, which of course doesn't have the tie-in to AI the way those other names do, it's down by 9%. Is this a re-rating of the AI story, the AI narrative, or is this just some air coming out of the bubble?
So I do think AI has the potential, as I say, to be sort of, kind of the big sea change that everyone has thought. But how long are you going to wait for it, right? So to answer that question, it's air coming out of the bubble now for sure. If you're going to stick with it and you think that longer term this is going to pay off, I don't think that's necessarily a bad bet. But it just may, we're talking out years probably, again, for most corporations to reflect, the benefits of this. And meantime, to your point, you've got a lot of other revenue sources kind of mixed up when you're investing in this big tech. So, what's your thesis on, obviously, we talked a lot about Magnificent 7 for so much of the last year, Magnificent 6 now, I guess. But there's a lot of different revenue sources in there. It's not just AI. You have to get a beat on ad sales bills, et cetera. So I will say this for a lot of investors who own this stuff, tilting a little bit towards small caps. I know it's a longer, slower burn, especially with higher rates for longer, but it still makes sense relative to what we're seeing.
All right, Dan, I wish we had more time. We're going to have to get you back on to talk about some of that pivot to small caps. Dana D'Auria, Co-Chief Investment Officer over at Investment. Meanwhile, for the large caps, the NASDAQ now down more than 2% on the day. Worst day going back to October. NVIDIA having an awful day. Worst day since 2020. Stick with us. A full breakdown of all the market action today as we take you to the bell and beyond.
Beyond the bell. Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with Carol Masser and Tim Stenovic. Alex Steele taking a well-deserved day off. Welcome to our audiences across all of our Bloomberg platforms. A pretty big sell-off going on right now, Carol, in the S&P and the NASDAQ, dragged down by big tech.
Yeah, absolutely. Like across the board. I just heard you talking on the TV side of things, Romaine, about NVIDIA and having its worst day in several years. I was looking at NVIDIA from March 25th when we saw that high on that name to today. We are down just shy of 20%. So very much a
1 minute remaining until we get the release of the April 2024 Financial Stability Report.
Couple of weeks here.
Well, earlier in our program, Abigail Doolittle was on.
Just to Carol's point too, because I was actually looking at that too. And then you go back to that March, at least with the NASDAQ 100, you go back to that March high, that March 22nd high. And I was going through the numbers here. I mean, we're down like 7% or something from that, which is just insane, given that we're only up like 9%. And I think we might have to recalibrate that given the selling into the close.
I'm calling it the reset week. I really feel like the tone is changing a little bit.
But is this a reset? I mean, you're talking about erasing like almost all the gains for the year. That's worse than a reset.
I mean, Dennis Gartman was on earlier today with Abigail Doolittle, and he said,
Abigail Doolittle.
Yeah, for Options Insight, and he said the bear market is just beginning. This is a bear market that's been long overdue, he says, and he's bearish right now.
So he sees a bit of a regime change here in the markets, but I mean, let's also not forget that we have a couple of things going on, right? Fears of Middle East retaliation over the weekend. There's no economic data today, and there's a lot of
persistent inflation and tighter monetary policy remain most cited potential risk to the financial system. And nearly 2/3 of respondents mentioned policy uncertainty as a risk, and significantly higher than in the October report. Commercial real estate and the banking sector stress less frequently cited as a stability risk than in the Fed's fall 2023 survey. Policy uncertainty, including escalating geopolitical tensions and upcoming US elections, are cited by 60% of respondents as potential financial stability risks. Concerns over uninsured deposits and other factors continued to generate funding pressures for a subset of banks. Leverage at hedge funds reached the highest level since data collection began. Cyber attacks, US-China tensions, Middle East conflicts also listed as risks, while non-banks in the Ukraine-Russia war have dropped off risk list. The report says 1,804 of more than 9,000